Abhishek,
Yes,
if you can hear
Abhishek is
us.
joined. Abhishek
Yes,
is
yes,
joining.
yes.
Yes, yes. Abhishek is
Hello, am I
joining.
audible?
Yes, Abhishek, loud and clear. If you can turn your camera on as well, please. Just make sure that
One
that's
minute.
also working.
Just try. I'm facing a little bit of issues with my camera.
Huh?
It's not turning on. I don't know why. Facing a little bit of issues with my camera.
Okay.
Could I go this way if it's not an issue?
If the camera is not working, I guess we'll have to do that. Obviously, seeing you is
Yeah,
always
no.
better than not being able to see you.
I know.
Right? Great.
Okay, I'll get the one with the zoom.
So what we could do maybe is Control C, so that everybody knows what you look like. I'll just paste the link to your profile on the CMT website on the chat.
I'm facing some issues. I'm not able to get the power on my camera. Anyways, I guess I'll start with this. I'll just share my screen.
Yeah. So I think we can wait for a couple of minutes as participants
Yes,
join. So yesterday I
Sure,
remember,
sure.
I think when I saw it peaked out at about 180, 190 participants. That was a wonderful turnout, sir.
yes, sir. Yes, sir. That's true.
So I'm counting on this because between the sessions that Abhishek, Prasanjit, and I have planned, it should hopefully be a very exciting day of learning also.
Yes,
So
sir. That's
I'm
true.
really hoping that
That's true, sir. There's
folks
no
are going
doubt
to.
about it. All the students had sent me the message and everything. So
Wonderful,
this is a
wonderful.
nice session they have. Because all of the maximum are the first years
Got it.
students.
Got it. Got
And they are really very excited about it.
it. Great. So good. In terms of structure broadly, we'll start with Abhishek. He'll cover 2 hours of introduction to the concepts of technical analysis. I will come in at 12 noon and talk for about an hour on one, careers in technical analysis. And second, if time permits, a little about trading psychology as well. And then after the break at 2 p.m., Prasanjit will come in and talk about the practical applications of the concepts that have been covered so far. So using real world tools in order to actually put these concepts into action. And for the case study, basically what the participants will all need to do is take the NSE 200, the Nifty 200 as an index, and from its constituents, applying both the concepts learned yesterday in fundamental analysis and today through technical analysis, narrow down to 1 or 2 trade ideas, stock ideas, and provide for that a fundamentals-based rationale on why they are choosing to invest in it, and a technicals-based rationale of why they're choosing. And with the technicals-based rationale, they'll have to also provide the entry price that they want to get in at, the target price, and the stop loss as well, with a rationale for each of the three. So that will be the case that will be discussed tomorrow. So Professor Banerjee as well can then talk about, for the same case, how might he have solved it, so that participants will get, then after having spent an evening going through and trying to apply these principles, participants will get an idea of exactly how they could have addressed these questions from the fundamental lens. And then Prasanjit will come in tomorrow and talk them through the same process from the technical lens. And we'll spend that time also taking questions. So Prasanjit's session can be a lot of interactive Q&A where people can ask their queries on what they did overnight, what are the processes they followed, what challenges they faced. Because I guess only if we are able to do it in practice will we be able to take it out of the classroom and actually practice it in the markets. And so what Prasanjit will also be focusing on is using real world tools. So tools that are actually currently freely available to anyone to go and start coming up with, because the idea of the workshop also was stock ideas, stock trading for the layman. So as a layperson, how do you come up with investment ideas and how do you go about making them true?
First of all, you just start the session, then you come to the comes the procedure. Okay,
Sounds good.
just wait for just uh, 1 or 2 minutes, then we start.
Certainly.
Okay, just
Mm.
actually, there is some technical issue. Maybe the SAD has doesn't join the session. There
I
is some
understand.
technical issue. Just for me, okay. Let's we start. Joel, after that, SAD and principal SAD also will be joined.
Right,
Okay.
right.
Okay. Okay. So, good morning, students, and good morning, Joel Kaiser. This is the first time I am seeing you. Lot of time we are talking in through phone, and Abhishek. Good morning, and all the students. Uh, just we upon call on stage our uh, CMT head, the Joel Pinnacle. Yes, to say something after we start our session. Please, Joel, over to you.
Thank you so much, Professor Shagato. Once again, to everyone, we had a quick chat yesterday, and we will have a quick chat, a longer chat later today as well for the first part of your session today. So let me just give you a quick overview of what to expect today and tomorrow, right? So, and I was just discussing this with Professor Shagato, and in fact, quite a few were already in the room. But just for your benefit, once again, uh, today's session is divided broadly into three parts. The first session is divided into two parts, and the second session will be one. So, the first session is from 10 to 1. Of that, from 10 to 12, my dear friend and CMT charter holder Abhishek Chinchalkar will be conducting the session. Abhishek is the head of education at Fires.in. Fires is one of the more aggressive up and coming um, uh, discount brokers or discount broking platforms in India. And in fact, it's an opportunity for all of you who are interested in stock trading to also explore a platform like this that will help you to actually trade and execute your trade ideas as well. So that's something that you should definitely take a look at. Abhishek works with Fires as the head of education. So he creates learning properties and helps young market participants like yourselves in order to be able to navigate the market in their initial phases. He's been a CMT charter holder for a number of years now, and he has about 10 years of experience in the financial markets, spanning equities, commodities, and FX research. Abhishek has also before this been a technical research analyst for Edelweiss and a number of other prominent companies. He's completed his uh, management. He's done more than one management degree. He's done one from the SP Jain School of Global Management and from an executive MBA from Sydenham as well. So you guys are in very good hands in terms of someone who can help you to understand the basics of technical analysis. Abhishek will spend about 2 hours with you, walking you through the basics, some key concepts around technicals, and he'll talk you through how these concepts apply in the from the technical analysis lens. I will come in at around noon, and I'll spend about an hour with you and talk about two things. One, I'll talk about careers in the world of finance. So with the benefit of learning technical analysis, what kind of careers open up to you? And we'll try to take a very macro view of the industry as a whole and look at what are the various kind of organizations within the industry and how do these organizations or industry types sub industries interact with each other, and from that we'll try to look at where does technical analysis fit across all of these, and how you might be able to go for a career like that. So we'll spend some time talking about that, and we'll also spend some time talking about trading psychology once again, subject to time permitting. We'll talk about trading psychology as well. Some of the things that in that you so it is one thing to learn theory, whether it's fundamental or technical analysis, and when you actually start applying funds to the markets, often a very large component of your actions is determined not just by the theory that you learned, but by the behavioral psychology that plays, what plays in your mind, your emotions, etc. also have a very big role in your performance as traders. So we'll spend a little time on that. It's obviously a much longer session, but I usually do a workshop on trading psychology from which I've condensed a small piece, which I'll share with you. Right. So we look at careers and industries, and we look at trading psychology. And then we'll take a break from about 1 to 2. And then at 2 p.m., Prasenjit Biswas will join us. And he will walk you through a very practical application of the concepts you've learned so far on the market. So he'll show you real world tools which you can use, in fact, today itself, to come up with ideas for investments. And tomorrow, as part of your case study, the expectation is that you will apply these principles learned, and from the Nifty 200 index, which is the top 200 stocks traded on NSE, you will come up with one or two trade ideas. And for these trade ideas, you will come up with both a fundamentals based rationale, on what basis, on what fundamental parameters that you learned yesterday are you deciding to come up with an investment idea, and technicals based rationale, on what technicals based parameters that you have learned today have you come up with that idea. And tomorrow we will discuss. So Professor Banerjee will talk you through and take questions about your experience in working with the fundamental side. And Prasenjit in the second session will take questions about the technical side. So tomorrow's session, I must prepare or warn all of you, is going to be entirely Q&A driven. It is going to be your responsibility to ask questions. It is not both Professor Banerjee or Prasenjit will not be teaching you something new, but just taking your questions and helping you refine your understanding based on what you actually have done. So in order to really benefit from that case study, it is very, very important that you actually apply what you have learned yesterday and today, tonight, as part of your homework assignment on the markets. Actually spend some time analyzing, and honestly, only that is the only way to really learn, so that you can then go on to platforms like Fire, Zerodha, and all the others, and actually execute trades. Yeah. So that's kind of the plan that we have for you for today. I am quite convinced that that is going to be this is going to be a very knowledge packed session. And I know Abhishek very well, I know Prasenjit very well. They are both wonderful educators, and they have a very strong grounding in the concepts of the financial markets as a whole and technical analysis in particular. They're both very well respected CMT charter holders. And on that note, I will turn it over to Abhishek. Unfortunately, Abhishek's camera is not working, but Abhishek, could you share your screen, please, so that we can make sure that the slide share is working?
1 minute.
So while Abhishek makes slide share work, I also want to mention that IEM is an academic partner of the CMT Association. And so, by extension, all the full-time students of IEM, whether it's engineering or management, all have access to scholarships to the CMT program. So maybe during my session, if you have any questions about availing the scholarships, what these scholarships are, what is the value of doing all that, that would be the time to ask me those questions. With Prasenjit and Vishwas, Prasenjit, sorry, and Abhishek, you can ask them questions about technical analysis and about the processes that they are teaching you, right? So I am very confident that you guys will have a fun learning day. Please be sure to learn as much as possible, absorb as much as possible, ask questions wherever you need to, and I'm sure that by tomorrow evening you will have a much more solid grounding on the process of stock trading, like Professor very wisely named the session, for the layman. Right. On that note, Abhishek, over to you.
Yeah, thank you, Joel, for the warm welcome. Good morning, everyone. Thank you for providing me this opportunity to talk, to give you a broad overview of what technical analysis is. So now that you already know me, I'll get started with the session right away. So I broadly split the session into two parts. In the first part, I'll be talking about the basics of technical analysis, and I'll guide you through understanding what technical analysis is all about. And in the second part, we'll take a slightly more challenging perspective of technical analysis and speak about a few slightly, more complex terms. So in the first part, I'll help you understand what technical analysis is all about, how it is different from fundamental analysis, what are the major assumptions on which technical analysis is based, what is a charting time frame, the chart, which is the heart and soul of technical analysis. So I'll guide you through that. There are several charts used in the context of technical analysis, so it's not possible to talk about all of them. I'll briefly help you understand which are the three most widely used and followed charts in technical analysis. Then I'll talk about the heart of technical analysis, which is trend, and what are the different types of trend. And finally, we'll conclude the first part of this session by discussing about one of the most popular used concepts in technical analysis, support and resistance. So let us start the session and understand what technical analysis is. So basically, technical analysis is a study of historical price action. You do so in the form of charts. So what you do is you look at various types of chart, and on the chart, the historical price and volume data will be displayed. Based on your understanding of the past price and volume action, you will make a logical prediction about the future. So in a very brief nutshell, that is what technical analysis is all about. Looking at the chart, analyzing the historical price and volume action, and based on your understanding of the historical price and volume action, making a logical and a calculated prediction about the future. The other area where technical analysis is used is to manage your risk. So if you are a trader, or if you are an investor, or if you are managing a portfolio, technical analysis can help you considerably in managing the risks of your trades, as well as in managing the risk of your investments and portfolios. So that is the other major critical aspect of technical analysis. Now, just like every forms of analysis, technical analysis is also based on a few set of assumptions. Now I'll talk about the three major assumptions on which the premise of technical analysis is based. The first major assumption is that the current price of the security discounts everything. Now, what do I mean by this? What I mean is the current price of the security that you can see, which is being traded in the market, reflects every possible piece of information that could possibly be discounted by market participants. So every possible piece of data, be it fundamental, economic, political, sociological, technological, etc., every piece of information that could be discounted is reflected into the price, and the current price that you see is the fair price of a security. Having said that, there are a few exceptions to this, and these are nothing but acts of God, because acts of God are something that you can't predict ahead of time. So for example, any natural calamities like earthquakes, tsunamis, etc., these cannot be predicted ahead of time. That said, whenever such natural calamities occur, they are quickly discounted by market participants and reflected into the price of the security. So the current price of the security, that is the price at which the security is trading at present, is believed to be the fair price of the security. So that's the first major assumption of technical analysis. The second major assumption of technical analysis is that the price moves in trends. So price movements are not random, but they tend to move in a particular trend. We will talk about trends in greater detail later in this session. But if you follow technical analysis, you have to assume that the prices move in trends and that the price movements are not random. Finally, the third major assumption of technical analysis is that history repeats itself. So what this means is that if a particular type of price behavior has occurred in the past, then it is very likely to occur in the future as well. Now that has again got to do with the human psychology of emotions, that is the basic emotions of fear and greed. It is this emotion of fear and greed that causes price to behave in a particular fashion, and that fashion keeps repeating time and time again. So if a particular pattern has worked well in the past, then you must assume that it is likely to work well in the future as well. Of course, what differs is the magnitude in which the pattern repeats. So no two patterns are exactly alike, but broadly speaking, the psychology within which the price patterns move tend to repeat again and again. So these are the three major assumptions on which the principles of technical analysis are based upon. Now, a more widely used, a question by a lot of people is, a lot of people ask, what is the difference between technical and fundamental analysis? Well, as you know, technical analysis is all about studying historical price and volume action through charts, assuming that the current price of the security reflects every possible piece of information and that it is the fair price, and based on your understanding of the past price and volume action, making a logical prediction about the future. So that's how a technical analyst analyzes the prices and the trends of securities. A fundamental analyst, on the other hand, identifies or calculates what should be the intrinsic value of a particular security. So through his study of various micro and macroeconomic factors, he tries to arrive at the intrinsic value of the security. He then compares that intrinsic value with the market price of the security, and based on the relationship between the two, he makes buy and sell recommendations. So broadly, this is the difference between technical and fundamental analysis. A person who uses technical analysis to make decisions relies on charts, and based on the past data, he makes a prediction about the future. A fundamental analyst, on the other hand, analyzes the various macro and microeconomic factors that causes the price of the securities to move, and based on that, he makes prediction about the future. So that's in general the difference between technical and fundamental analysis. Now, technical analysis, as I said, is all about charts, and you can analyze chart across various different types of time frames. Broadly speaking, the time frame on which you can analyze a particular chart of a security could be split into three parts. One is the shorter term time frame, other is the medium term time frame, and the third is the larger term time frame. Now, what is a shorter term time frame? It refers to charts that displays data relating to tick prices, minute prices, hourly prices, etc. So shorter term time frames refers to those charts that display very short very small or shorter time frame movements in prices. Now, shorter term time frames are primarily used by day traders, those who take positions today and close those positions either by the end of the day or in just 1 or 2 sessions. So shorter term time frames are primarily used by short term traders. Then you have medium term time frame. Now, the two widely used time frames within the medium term time frame is the daily and the weekly chart. So in the daily chart, if you're looking at the daily chart, each data point will reflect the price action of one day. If you're looking at the weekly chart, each data point will reflect the price action of 1 week, and so on. Medium term chart, medium time frame is primarily used by intermediate term traders or those who kind of take position today and hold on to that position for a month or two, or maybe even 6 to 8 months. And finally, you have the larger term time frame, that is the monthly, quarterly, and the yearly chart. Now, in the monthly chart, each data point reflects the price action for 1 month. In the quarterly, each data point reflects the price action for 1 quarter, and so on. Now, these are very long time frame charts and are typically used by investors who believe in taking positions today and holding on to those positions for 1 year or 5 year or 10 year, etc. So if you're a day trader or if you're a very short-term trader, then you will be looking on charting timeframes that display the tick data, the minute data, the hourly data, etc. If you're an intermediate term trader who's trading for say 1 month or 6 months, etc., you look at the medium term time frame, that is the daily and the weekly chart. And if you're an investor or if you're a long-term trader who believes in taking positions and holding on to them for 1 year or more, you would typically be looking at the larger time frame, that is the monthly and the quarterly chart. Yearly chart is also used, but it's not that popular. So these are the three time frames used by technicians. Going forward, whenever we talk about time frame in today's session, we'll primarily refer to the daily time frame because that is one of the most widely used forms of time frames. Now, before we look at how a chart looks like, let me just add that charts used by technicians or technical analysts are two-dimensional. So they consist of x-axis and the y-axis. The x-axis or the horizontal axis that appears at the bottom reflects the time. So it denotes the time. On the other hand, the y-axis or the vertical axis reflects the price. So it displays the price of a security. Now, let me briefly talk about the three of the most widely used charts across the world. So one of that is the line chart, which I believe you might already be aware of because this is a type of chart that is frequently showed in news, that is frequently used by economists, that is frequently used by fundamentalists, etc. Now, the line chart displays only one element per period, and that is the closing price. That is the price at which the security closes for a particular time frame. So if you're looking at the daily time frame, the line chart will display data for 1 day. As said, the x-axis denotes time and the y-axis denotes price. So now let's look at how a line chart looks like. This is how a typical line chart looks like. So as you can see, it is plotted continuously by connecting one data point with the previous data point. So as I said, I'll be by default referring to the daily time frame. So this is the daily price chart of the Nifty 50 index, which is the benchmark stock market index in India and one of the most widely followed indices in India. So this is how a line chart looks like. So as you can see on the x-axis, you have period. So the current data displays the price action from October 2019 all the way up to August 2020. So what this shows is that it shows the closing price of each day. So the closing price of 1 day is connected with that of the previous day, and then a continuous line is plotted. So just by looking at the line chart, you can see how the security has behaved in the past. So as you can see in the first half of the chart, the security trended higher. Then there was a very steep decline, and then there has been a steady and a gradual recovery in the days ahead. The second most widely used chart type is the bar chart. Let me take you straight to how a bar chart looks like. So each bar looks somewhat like this. So the bar that is on the left, so basically a bar chart displays 4 pieces of information on any day. So it displays the opening price, that is the price at which the security started trading on that day. It reflects the high and the low price, that is the highest price at which the security traded that day and the lowest price at which the security traded that day. And finally, it displays the close, which is the price at which the security closed for that day, or the last traded price for that day. Now, as you can see, the high, of course, appears at the top of the bar and the low appears at the bottom. Across this vertical line are 2 horizontal dashes, one that is on the left and the other that is on the right. The one that is on the left of this vertical bar reflects the opening price, and the one that is on the right of this vertical bar reflects the closing price. Now you may wonder, why is this bar green in color? The reason why this is green in color is because the closing price is above the opening price. As you can see, the close is above the open, and whenever you have a close that is above the open, typically the bar is green colored. The opposite of that is a bar whose closing price is below the opening price. So whenever closing price happens to be below the opening price, the bar is typically red colored. In your charting platform, you can, of course, change the colors of the bars as per your likings, but typically a bar that has a closing above the opening is green colored, and a bar that has a closing below the opening is red colored. Now, the size of the bar can vary from one period to another. So it is not necessary that the size of the bar is fixed. Keep in mind that the smaller the bar, the smaller is the range of the day. That is, the smaller is the difference between the high and the low. And the larger the bar, the higher is the difference between the high and the low. So basically, the length of this vertical line can tell you how volatile the security has been for a particular period. The larger the vertical line, the larger is the volatility, and the smaller the vertical line, the smaller is the volatility, and so on. Another thing to note is that the open and the close could be anywhere within the range of this vertical line. So in this case, we have opening over here and closing over here, but it can occur anywhere within the range of this vertical line. So this is how each bar is constructed. So each bar reflects the price action for one period. If you're looking at the daily chart, each bar will reflect the price action for one day. If you're looking at the monthly chart, each bar will reflect the price action for 1 month. And if you're looking at, say, a 1 minute chart, each bar will reflect the price action for 1 minute. So this is how a bar chart looks like in real time. Now, as I said, you can change the color as per your likings. Now, in this particular chart, the red bars are those that have a closing below the opening, and the blue bars are those that have a close above the opening. Now, whenever the closing is above the opening, such bars are also called as bullish bars because the closing is above the opening. Similarly, whenever the closing is below the opening, such bars are also termed as bearish bars. So bullish and bearish are two terms that you will frequently hear in the financial markets. A bull is someone who expects the price to go up, while a bear is someone who expects the price to go down. So bull and bear, or bullish and bearish, are two of the most widely used terms in the financial market. So you need to be aware of those. In the same context, a bullish bar is the one that has a closing above the opening, while a bearish bar is the one that has a closing below the opening. So in this particular case, this is again the daily chart of Nifty. So each bar reflects the price action for each day. So this is how a bar chart looks like. Then the third and the most widely used type of chart, this is one of my favorite charts. I by default use the candle chart. Uh, Let me take straight away to what each candle looks like. Now, one thing that you need to keep in mind is that each candle will reflect the same piece of information that each bar reflects. That is, each candle will display you the open, the low, the high, and the close for each period. So you get the same piece of information in a candle chart as to what you get in a bar chart. The only difference is the visual appearance. So if you remember, in case of bars, we had the two horizontal dashes across on either side of this vertical line. In case of a candle, however, what you have is a body, a rectangular body. I would ask everyone to be on mute if possible. Yeah, thank you. So just 1 minute. So as you can see in this particular case, instead of the two horizontal dashes on either side of the vertical line, what you have is a body, which sort of looks like a candle, and hence the name candle chart. So if the closing happens to be above the opening, you have a bullish candle, or typically a green colored candle. Similarly, if you have closing below the opening, you have a bearish candle or a red colored candle. Again, you can change the color of the candle as per your likings, but typically a green candle reflects a candle whose closing is above the opening, and a red candle reflects a candle whose closing is below the opening. The highest point of the candle reflects the highest price at which the security traded for that period, while the lowest part of the candle reflects the lowest price at which the security traded that period. Again, you need to keep in mind that the body, that is the difference between the close and the open, can take any shape. It could be, it could kind of take the shape of the entire candle, or it could be very small, and so on. So this is how a candle chart looks like. Again, this is the same chart of the Nifty 50 index. Now each candle over here reflects the price action for each period. So as you can see, in this particular case, each red candle is a bearish candle whose closing is below the opening, and each blue candle is a bullish candle whose closing is above the opening. So in this, now the difference between bar and candle chart is that a candle chart is more visually appealing. So by looking at the size of the candle and by looking at the size of the body of each candle, you get the feeling of market psychology. You kind of get to understand how the buyers and sellers are positioned. So in short, you get a much more stronger visual appearance. That is, you get much more clearer market psychology, and as such, candlestick chart is more visually appealing than a bar chart. So if you look at a bar chart, because of the horizontal dashes, you don't get as clear information as you can in a candle chart. So candle chart gives you the real feeling about the market psychology of buyers and sellers, and that is one of the reasons why candle chart is more widely followed. So primarily speaking, these are the three commonly used charts in technical analysis: line, bar, and candle. Besides these, there are many other charts as well, but those are not as widely used as each of these three charts are. Now, if you're a trader, you will primarily be using either a bar chart or a candle chart, for the simple reason that a line chart displays only the closing price while ignoring the high and the low. So a line chart, as you can see, tells you less information as compared to a bar or a candle chart. So for this reason, a bar or a candle chart are more widely used by traders, for the simple reason that they provide more information than a live chart does. Okay, so by now we have talked about what technical analysis is, how it is different from how is it different from fundamental analysis. We talked about the fact that charts are two-dimensional. We talked about the different time frames that technicians use. And finally, we also talked about three of the most commonly used charts. If you remember our discussion when we were talking about the assumptions of technical analysis, one of the assumptions was that prices moves in trends. Now in this section, we'll talk about what a trend is. So you might have heard of this term quite frequently. It's a part of our day-to-day routine. You will come across this term trend. The meaning in technical analysis is also more or less the same. So basically, a trend is nothing but the general direction in which the price of the security is heading. So it is the general direction of the price trajectory of any security. Now, technical analysis is all about identifying trends of the security, and based on your identification of the historic trends, deriving logical predictions about the future trends. So trend is the heart and soul of technical analysis, and everything in technical analysis, kind of moves around the trend. The objective of any tool that you use in technical analysis is to understand what the underlying trend of the security is. So as a technician, what is your objective? That is, if you follow technical analysis, what is your objective? Well, put it in simple words, your objective is to identify the historical trend, and based on your identification, derive logical prediction about the future. That is what technical analysis is primarily about. Now let's talk about the three types of trend. So at any point in time, the price of a security could be trending higher, it could be trending lower, or it could not be trending. So you could have the price of the security in one of three states: a state where the price is trending up, a state where the price is trending down, or a state where the price is broadly not doing anything. It is just consolidating in a lateral band. So what is an uptrend? An uptrend, as you can see in this hypothetical chart, is a pattern that denotes a sequence of higher highs and higher lows. So as you can see from this chart over here, each high is above the previous high. So the second high is above the first high, while the third high is above the second high. Similarly, each low is also above the previous low. So in this case over here, you can see that the second low is above the first low. So you have a sequence of higher highs and higher lows, and that is what causes the price to keep moving higher, the sequence of higher highs and higher lows. So an uptrend is nothing but a sequence wherein price is making a sequence of higher highs and higher lows. This is how an uptrend looks like in the real world. Now, this is the chart of the Nifty 50 index. So as you can see from this point, initially the trend was down. As you can see, the price was heading lower. And from this point, the security in question started trending higher. So look at each red arrow, which denotes an important high, and look at each green arrow, which denotes an important low. So as you can see, each high is taking price above the previous high. On the other hand, each low is not breaking below the previous low, but it is above the previous low. And what you have is a nice uptrend in action, a state where price is trending higher, a situation that tells you that buyers are in control of prices and not sellers. The opposite of an uptrend is downtrend. So a downtrend is a sequence of lower highs and lower lows. So as you can see, each successive high is below the previous low, and each successive low is below the previous low. So you have a sequence of lower highs and lower lows. So this is a downtrend in action. So after topping out over here, you can see that the security in question, which is BALE, which is a stock that's traded on the Indian exchanges, you can see that the security steadily headed lower. So you can see that each important low is taking the price below the previous low, and each important high is also below the previous high. So you have a nice sequence wherein price is making a sequence of lower highs and lower lows. So this is a downtrend in action. And then finally, you have a sideways trend. That is a trend in which the price is essentially not doing anything. It is just consolidating in a lateral band. Neither is one high going above the previous high, nor is one low going below the previous low. So you have highs that are more or less at identical levels, and you have lows that are more or less at identical levels. So a downtrend reflects a situation wherein neither the buyers nor the sellers are in control of the market. Now, if you could recollect, in an uptrend, the buyers are in control, and that is the reason why price is trending higher. In a downtrend, the sellers are in control, and that is the reason why price is trending lower. In a sideways trend, you have a sort of equilibrium in which the buyers and the sellers are equally positioned, because of which the price is not clearly trending and is just consolidating in a lateral band. So a sideways trend tells you a situation wherein neither the buyers nor the sellers are in control. Now, this chart over here, this is the chart of the dollar rupee exchange rate. This chart over here reflects a sideways trend in action. So after the initial up move, for the next several days, if you see, the dollar rupee exchange rate was neither heading up nor heading down. If you look at the highs, they are more or less at identical levels. And if you look at the lows, they are also more or less at identical levels. So the buyers and the sellers are in equilibrium, and you have a state wherein price is neither going up nor down. So broadly, these are the three states in which the price of a security could be in. The price could be either in an uptrend, or it could be in a downtrend, or it could also be in a sideways trend. Now that we understand what a trend is and what are the three different types of trend in the market, let me briefly talk about two of the most widely used terms in technical analysis: support and resistance. What is a support? So basically, a support is a price level where you can expect the demand to be higher than supply, which would cause the price to start trending higher. On the other hand, a resistance is a level where supply tends to be greater than the demand, which causes the price to start trending lower. You can think of a support as a floor, and you can think of a resistance as the ceiling. So a support is equivalent to a floor, a level where the demand typically tends to exceed supply, causing the decline to halt and price to start heading higher. A resistance, on the other hand, is a level where the supply typically exceeds the demand, which halts the rally in price and causes the price to probably start trending lower. Another way to think at this is that a support is a level where you can expect a strong buying interest to come in, where you can expect the buyers to be aggressive, while a resistance is a level where you can expect sellers to be aggressive, where you could expect a lot of overhang supply. So we have already talked about the three types of trend. So basically, in an uptrend, each high is nothing but a resistance, and each low is nothing but a support. So an uptrend is a situation wherein the previous resistance is being broken, but the previous support is not being broken. So as you can see, the supports are coming in at higher and higher levels, but so are resistances. The resistances are also coming in at higher and higher levels, and that is causing the price to trend higher. Similarly, in a downtrend, what typically happens is that the resistance comes in at lower and lower levels, and the support also comes in at lower and lower levels. Now, when a market is trending, typically what happens is that one of supports or resistances tend to break. So in this case, you can see a downtrend that is in action. So in this case, as you can see, the supports are not being held, the supports are being broken. So the demand is not coming in at previous lows, and that is causing the price to trend lower. So in a downtrend, you will typically see prior supports being easily broken, while in an uptrend, you will typically see prior resistances being easily broken. In a sideways trend, both supports and resistances hold. That is, buying comes in at supports and selling also comes in at resistances. And that causes the price to move in a lateral range. Now, one thing as analysts or as chart followers that you need to keep in mind is that supports do not hold forever. Similarly, resistances also do not hold forever. There are occasions wherein supports are broken or situations wherein resistances are broken. Now, what happens is that when a support breaks, going forward, it could switch its role into a resistance. Similarly, when a resistance breaks, going forward, it could switch its role into a support. Let us understand how. So this is again a theoretical, a hypothetical chart. So initially, as you can see, price is trading sideways in this particular range. So the high is acting as a resistance or as a ceiling, and the low is acting as a support or as a floor. At this point in time, if you see the region over here, the price broke above the resistance. That is, the price managed to break above the previous two highs. So what is happening is that the resistance is broken. It went up from there, came down. Now, if you see that previous resistance, which was a ceiling over here, has now acted as a support or as a floor over here. So as you can see, this resistance has switched its role into a support. This is nothing but the change of polarity principle, a resistance turning into a support. The opposite could also happen. A support could turn into a resistance. So, so again, continuing with this chart. So from here, we can see that a former resistance acted as a support. Price went higher, came down, went higher again. It didn't cross the previous resistance in this particular case. So the previous resistance was held. It started coming down. And then over here, as you can see, the support, that is the previous low, was broken. Going forward, this particular support could switch into role, could switch its role into a resistance. So that is how, from time to time, a support could convert into a resistance when broken, and similarly, a resistance could convert its role into support when broken. Let us understand that using a real-time chart. Now, this is the chart of dollar rupee exchange rate, which we presented earlier. So as you can see, initially after this decline, price rallied, came back down again, rallied from here. Now these two lows are nothing but supports. These are floors. It went up and it broke above the previous high. So the high point is being broken. So what is happening is that a resistance is being broken. Now going forward, look at how that resistance turned its role into a support. So what is happening is this area was an area where sellers were previously aggressive. Now at that same area, the buyers are very aggressive. That is causing the price to hold above this resistance. So this is a very beautiful chart wherein a former resistance is switching its role into a support. So you can see on multiple occasions, this high was acted as a support over here. That is, this was a point where buyers were very strong compared to sellers. Eventually, as you can see, price went up and then broke above the previous high points. Now, these high points are nothing but resistances. Price went up, broke above these resistances, and the moment it broke above these resistances, you could see the dollar rupee started trending sharply higher from around 72.5. Within days, dollar rupee rallied to 77. Now, that's a very strong up move, especially considering that we are talking about exchange rate, which is typically very well managed by the central bank. So as you can see in this particular case, this is a very nice chart showing how a former resistance switched its role into a support, and later when the resistance was broken, a very powerful rally got underway in the dollar rupee exchange rate. So this is a very a very interesting chart, and this is typically how markets tend to behave in the real world. So here are some important points that you need to keep in mind about supports and resistances. The first is that the longer a support or a resistance is held, the greater is its significance. As you can see in this point over here, this resistance was held, this support was held multiple times, making this particular support very critical. And going forward, this support was never really broken. the resistance which was held thrice was eventually broken. Now, an important thing to keep in mind is that the higher the number of times a support level is held, or the higher the number of times a resistance level is held, the greater is its significance. In this particular case, this particular level held thrice, and you can see the moment it broke, there was a very powerful rally. So this is the first thing that you need to keep in mind about supports and resistances. Another thing to note is that you need to look at how the volume activity is when a price reaches a support or a resistance area. I have not shown volume over here because I didn't have the requisite data. But if you're trading a resistance breakout, or if you're trading a support break, you need to see how volume activity is. Typically, there has to be a pickup in volume activity. If a resistance break is accompanied by an increase in volume, it tells that there is strong buying interest. Similarly, if a support break is accompanied by an increase in volume, it tells that there is strong selling interest. So volume, is an important factor that you need to take into consideration, especially around important supports or resistance levels, because it gives you the psychology. It helps you understand the psychology of the price behaviors. Then, as said, whenever a support or resistance break is accompanied by an increase in volume, it enhances the validity of a break. So if a particular resistance is broken, and if that resistance is accompanied by an increase in volume, it increases the possibility that the price will head higher. On the other hand, if a resistance break is accompanied by dull volume or very weak volume, then that breakout could be questionable, and you need to wait for more evidence from the price action before acting. Finally, if a support or a resistance break has failed, then that in itself could tell you the strength of a trend. So if a particular resistance level, now let's say in this particular case, if the resistance had broken, and instead of continuing to go higher, if the prices had reversed back below the resistance, then that tells you that the resistance breakout has failed and probably will start seeing a lower move. So you need to keep an eye on how the price behaves when a resistance or a support is broken. Typically, a resistance break must be accompanied by a move higher in price. But if it is not, if the break fails and the price starts trending higher, starts trending lower, it could signal that we could see a move lower. So these are some of the important guidelines that you need to keep in mind in the context of support and resistance. So that kind of covers the first part of our session. So we spoke about what technical analysis is. We spoke about how technical analysis differs from fundamental analysis. We spoke about the three major assumptions on which the principles of technical analysis are based upon. Then we went on to speak about the different time frames that chartists use. We spoke about the three most commonly used charts, that is line, bar, and candle. Then we spoke about trend and its three types. And finally, we spoke about what is a support, what is a resistance, and what happens when a support is broken or when a resistance is broken. Now, in the second part, I will talk about these four concepts: drawing a trend line, classical patterns, technical indicators, and finally, I'll conclude by discussing about risk management. So let's start with the trend line first. Just one moment, let me have a sip of water. Okay. So in the previous section, we understood what a trend is, and we saw that trends could be of any one of three types: up, down, or sideways. That is, price could be in any one of three states, that is upwards, downwards, or sideways. Now, an easy way to identify the trend of a security is by drawing trend lines. A trend line is nothing but a straight line that connects either two successive lows or either two successive highs. So basically, just like trends are of three types, that is up, down, and sideways. Similarly, trend lines could also be of three types. One is a trend line that is upward sloping, other is a trend line that is downward sloping, and third is a trend line that is horizontal, which indicates an equilibrium. Now, an uptrend line is a line that connects supports or a line that connects lows, while a downtrend line is a line that connects resistances or highs. So this is how an uptrend line typically looks like. So in this particular case, you can see a trend that is going higher, wherein each high is crossing the previous high and each low is above the previous low. So you have a classic uptrend in action. Now, how do you draw trend lines is that in case of an uptrend line, you connect two important lows. So initially, as you can see, price fell, rallied. Okay, here you have the first low, fell from there, started rallying again. The moment price starts rallying from the second low, you can kind of safely assume that a low is probably in place. So now that you have two lows to connect with, you can draw a trend line. Let me say that again. In order to draw an uptrend line, you need to identify two low points. So how do you identify that? Once the price makes a second low and starts rising from there, let us say price is reached up to this point. That is the point where you can safely infer that probably the second low is in place. And now that the second low is in place, you need to go to your charting toolbox, select trend line, and then connect the lows using that trend line. So this is how an uptrend line can be drawn. Now, what is the function of the uptrend line? The function of the uptrend line is to identify future areas of support and resistance. In case of an uptrend line, the function of an uptrend line is to identify future supports. In case of a downtrend line, the function of a downtrend line is to identify future resistances. So in this particular case, after price started rallying from this point, once you have drawn the trend line, going forward, if that trend line acts as support and price starts rising from there, that is the region where you could think of buying the security in question. So let us say price fell up to here, came near the vicinity of the trend line that you had drawn, and then started rising from here. So the moment it starts rising, you can kind of safely infer that the trend line has been tested and it has been defended as a support. So probably you can think of buying the security in that particular case. So the objective of using an uptrend line is to identify future support levels. That is regions where you can think of buying a security. On the other hand, what if the uptrend line had broken? Then in that case, it would indicate that the buying has faded out and we could see lower prices going forward. Now, in a similar fashion, you could draw a downtrend line. In order to draw a downtrend line, all you need is to identify two important highs. The moment you identify two important highs, you can draw a downtrend line in order to identify future areas of resistances. So let us say in this particular case, you already had one high over here. Then price rallied from this low point, it came to here, started declining. The moment price started declining from this high point, you can kind of safely infer that probably a high is in place. And because you can kind of see two highs, you could draw a trend line, that is a straight line that connects, that passes through each of these highs and extend it into the future. Going forward, that trend line should typically act as a resistance. If the rally from this point halts near the trend line and starts declining, you could think of short selling the security over here. In the fourth attempt also, as you can see, the trend line has acted as a resistance. Before showing some real world charts, let me just mention some important guidelines of trend line. One is that the angle of the trend line is important. So whenever you draw a trend line, look at the angle. Is it steeping very much If it is steeping very much, then it's likely that the trend line will be broken sooner rather than later. On the other hand, if the trend line, if the angle of the trend line is gentler, then that trend line is likely to hold for a longer period of time. So the angle of the trend line can tell you whether that trend line will act as a strong area of support or resistance in the future. So whenever you draw a trend line, please do look at the angle of that trend line. The second is how many times a trend line has been tested. If a trend line has been, once after you draw a trend line, if it has been tested multiple times in the future, that trend line is very significant. Eventually, if that trend line is broken, you can expect at a reversal in trend. But as long as the trend line does not break, you can expect the trend to continue. So the greater the number of times a trend line is touched without breaking, the greater is its significance. Now, third is a very subjective, guideline. That is, if you're drawing a trend line, and if that is not perfectly fitting onto the price, then don't force that trend line. So only draw trend lines when it is kind of smoothly fitting onto the price. Don't force the trend line. If it's not fitting very well, then you can kind of ignore it and wait for more clarity to emerge. Just like I said about support and resistances, keep in mind that trend lines do not hold forever. At some point or the other, a trend line is broken. When a trend line breaks, it indicates that the trend is reversing. However, before deciding to act on the opposite side, you must use some other filter such as volume or stuff like that. Like for example, if a particular trend line is broken, you would want to see volume increasing on that break. If the volume is increasing, then it tells you that the break is probably genuine and you can go ahead and initiate an opposite trade. So let me go back to the previous example. So in this particular case, you can see that price is respecting the trend line, which tells you that the downtrend is very much intact. But going forward, if this trend line breaks, that is, if price manages to move above this trend line, then you have to see what is the volume doing. Typically, what a trend line break tells you is that when a trend line breaks, it signals at a reversal in trend. It tells you that this downtrend has probably ended, and we could be in a period where the price starts trending higher, or we could enter a consolidation range. So before deciding, to kind of act following a trend line break, you need to see how other features are. That is, are you getting a closing above this trend line? Is there a pickup in volume activity and stuff like that? I'll talk more about this going forward. So this is an uptrend line in action. So in this particular case, this is a chart of the Nifty 50 index. What I did was I identified two important lows. One is this low and the other is this low. Once price started rising from this point, I connected the two lows, this low over here and this low over here, and projected into the future. So as you can see in this particular case, this trend line acted as a support to price, a region where you could probably think of buying the security in question. Now, over here, I've drawn two trend lines. The first is the downtrend line, which connects important highs. So as you can see, the first high is over here. The second high is over here. Now, in this particular case, look at the angle. The angle of this trend line was way too steep. It was sloping downwards quite dramatically. So the possibility that this trend line would be broken eventually is much higher, because it is very difficult for price to keep maintaining that angle of decline. So at this particular point, the trend line was broken. And once the downtrend line broke, see how price started trending higher. Going forward, as the price started trending higher, there was one low over here and then another low over here. You could connect those lows to identify where a future support could rise. So once you plotted the trend line following a low over here, You could see that in this particular case, the trend line acted as a support. The moment price touched that trend line, it rose quite nicely from that point. But eventually at this point, the trend line was broken, and then you saw a decent decline in the price of the security. One thing to keep in mind is that following a breakout from a trend line, look at the bar or the candle of following that break. So in this particular case, once the trend line was broken, you could see that like 3 consecutive bullish bars or blue bars started emerging. So the occurrence of consecutive bullish bars was kind of signal that the downtrend has probably ended, and we could see higher prices going forward. Similarly, look at this particular instance. When this downtrend line broke, that break was accompanied by a very long red candle or a very long bearish candle. So that break tells you that the break has been accompanied by sellers outpowering the buyers. We had a very long red candle. And what was the result of that red candle? Following a brief consolidation, price started falling sharply. So the size of the candle or the size of the bar following the break of a trend line can give you a lot of clues in terms of whether that break is genuine or whether that break is false. So this is how you can use multiple trend lines. So once a downtrend line is broken, you can immediately you can going forward draw an uptrend line if you are able to find 2 important points or 2 important flows that you can connect on the chart. Again, an important thing to keep in mind is that in case of a downtrend line, as long as the price is trading below the downtrend line, you would use the approaches towards the trend line to short sell the security. When price, however, breaks above the downtrend line, you would be exiting your short positions and you would be probably trading on the long side. That is, you're probably looking at buying opportunities. Similarly, in case of an upwards, in case of a trend line that's pointing upwards, you will be looking at the test of trend line to buy the security. So whenever the price tests the trend line and bounces off it, you will be looking to buy. However, when the price breaks below an upward pointing trend line, you will be on the lookout for short selling opportunities. So that's how you kind of buy and sell using trend lines. As long as the trend line is not broken, you would initiate a position in the direction of the trend line. However, when a trend line breaks, you would typically look out to initiate positions against the direction of that trend line. So trend lines, once you start using charts, you will notice that trend lines are one of the most widely used and simple way of identifying the health of the trend. The trend line, as I said, could either be sloping upwards or it could be sloping downwards, or it could be horizontal as well. The trend line could be a straight, horizontal line as well. It's a very widely used tool that is used to identify the strength of the trend, and one that is used to identify whether you should be buying or selling. Now, once you start using technical analysis, you will come across something called classical price patterns. As I said earlier, when talking about the assumptions, one of the major assumptions of technical analysis that history repeats itself. So if a particular price has behaved in one manner in the past, it is likely to behave in a similar manner in the future. What, however, differs is the magnitude, of course. So price patterns are one way of determining trading opportunities. There are several price patterns, as you can see from this list over here. So you could, you could have head and shoulder, top and bottom, double top and bottom, triple top and bottom, rectangles, triangles, broadening patterns, wedges, broadening wedges, flanks and pennants, rounding tops and bottoms, cup with handle, diamond tops and bottoms. So these are some of the most, widely used, some of the most time-tested patterns that have worked well in the past and that work very well today as well. So these are some of the most time-tested classical price patterns. Of course, it would not be possible to talk about each and every pattern because it's a very extensive subject in itself. So let me briefly talk about a head and shoulder pattern. Let's focus on a head and shoulder top, which is one of the most widely used, and one of a very reliable price pattern. So just one second. So yeah, so let me briefly briefly tell you what a head and shoulder top is. So basically, a head and shoulder top is a reversal pattern. It indicates at a reversal in trend. So initially, as you can see, before the pattern occurred, the trend was up, but after the pattern emerged, the trend was down. So it indicates at a reversal in trend from up to down. Sorry. Now, why the name head and shoulder? Because the pattern sort of looks similar to head and shoulders of a person. So let's talk about how this pattern is. So initially you have an uptrend wherein the security in question is making a sequence of higher highs and higher lows. Then price makes one particular high, starts declining from there, comes up, breaks below the previous high. So what you have is a resistance being broken, goes up, starts declining, makes a low, comes up again. Now in this instance, if you see, it has made a lower high. So this high is below this high. So you have a lower high, it starts coming down from there. The moment the price starts declining from this high, you can see that the shape of this pattern resembles a head and shoulder basically. So that is why the name of this pattern is a head and shoulder. So you have a head that is the highest point in this pattern, which is supported by the two shoulders. This is the left shoulder and this is the right shoulder. Going forward, now again, what we have done over here is we have drawn a trend line. So whenever you come across a classical price pattern, you need to draw a trend line. So, trend line, as I said, is the heart and soul of technical analysis. Once you start using charts, you will see that you use trend lines quite often. So it's a very popular tool. It's unquestionably one of the most widely used tools by those who use charts to make trading or investment decisions. So what you can do is the moment price starts rising from this low point, because you have two definable lows, this one over here and this one over here, you can draw a trend line that passes through these two low points and extend it into the future. Going forward, if the decline from this high causes the price to break below this trend line, it indicates that the trend of the security has turned from up to down. So when this trend line breaks, you would be looking to short sell the security. That is, you would be looking to sell somewhere over here and then buy back later at a lower price. Now, the next question that arises is, what is the extent of the down move once price breaks below the neckline of this pattern? Well, in order to calculate how much the price is likely to decline, what you need to do is you need to calculate the vertical distance between the top of the head, that is the highest point of this pattern, all the way down to the neckline. So it should be a vertical line. It should be vertical. So a straight line from the top of the head to the neckline. That distance you will subtract from the point at which the price broke below the neckline. So this distance will be subtracted from this point. So this region over here is the minimum price objective of the head and shoulder pattern. So once price breaks below this, you would be looking to short sell the security over here with the objective of buying back somewhere over here in the future. So as I said, a head and shoulder top is a bearish reversal pattern because it indicates at a reversal in trend from up to down. The reason why it is called head and shoulder is because it looks like one. You have a head that is that is separated by two shoulders around it. The moment you spot a head and shoulder sort of pattern, in this case, as you can see, you can spot the two lows over here. The moment you are able to spot that, you will draw a trend line. Going forward, if price breaks below the trend line, it tells you to short sell the security for a price objective somewhere over here, which is nothing but the vertical distance between the head and the neckline subtracted from the breakdown point. Now, it is important that this shoulder, the right shoulder, is below the head. So the high of the right shoulder should be below the high of the head. If not, for example, if you have a situation wherein the high of the shoulder is above the head, then you don't have a head and shoulder. So it is important that the high, for that matter, it is important that each of the two highs of the shoulders, of the two shoulders, should be below the head. Then only you have a head and shoulder pattern. Now, head and shoulder patterns don't work always. Let us assume a hypothetical situation wherein you sold the security over here, but instead of price continuing to move over, it started reversing and started going higher. In that case, you would be caught on the wrong side of the trade. So what would you do? Because if you start making losses, at some point you need to exit your trade, right? So what would you do? Where would you exit? A safe point to exit is above the high of this shoulder. So going forward, if the trend line is broken, you initiate a short position, but instead of the price continuing to move over, if price starts trending higher and then goes on to break above the high of this shoulder, that is one point where you could possibly consider exiting your short position with, of course, a loss. It's important that you manage your risks very well whenever you initiate a position, because in case the price does not behave as you expect to, then you should know where to exit in case you start making losses. So how would you trade this pattern is that you would sell over here, your stop loss would, or this would be the region where you would close out your position in case your trade turns out to be wrong. And this is your favorable position. Going forward, if price declines up to this point, that is the price objective, you make money. So that is how you initiate trades. We've already talked about what head and shoulder is, so we could briefly go through what it is. I forgot to add one thing over here. Now look at this. Look at the shape of the trend line. If you see the trend line, which is the red colored trend line, the one that connects the lows of the two shoulders. If you see that trend line is sloping slightly higher because the two lows are not occurring at identical levels, but it's that the second low is slightly above the first low. So what you have is a trend line that is sloping slightly higher. In a similar fashion, you could also have a trend line that is either horizontal, wherein the two lows are more or less at the same point, or you could have a trend line that is sloping slightly downwards as well. And that occurs when the second low is slightly below the first low. So in that case, the trend line would be sloping slightly downwards. So the shape of the trend line, or basically the angle of the trend line, could be any one of up, horizontal, or down. So that is a thing that you need to keep in mind. In this case, this is the chart of Hindalco, which is a metal stock, a company that produces, a company that is into the production of metals. So in this case, as you can see, initially the trend is up, the price is going higher. It reached its highest point over here. From there, it started declining. There was a minor rally from that point. Now, as you can see, you have two identifiable lows. One is over here and the other is over here. The moment you see such identifiable lows, you could draw a trend line. Now, of course, if going forward, had price continued to rally from this point and broken the high of the head, we wouldn't have had a head and shoulder. But in this case, price did not break the high of the head on the right shoulder. So what you have is a lower high. So this high is below this high. So you have a potential head and shoulder in the making. And at this point, if you see, that trend line was broken. If you look at the shape of the bar, in this case candle, what you have is a nice red candle following the trend line break. So you have a healthy red candle. So looking at the shape of that candle, you could consider going short once the trend line broke. Now, what should be your stop loss? Ideally, the stop loss should be above the high of the right shoulder. Of course, you could, as you gain more and more experience in trading, you could find out various ways to decide where you should be placing your stop loss in case your trade goes wrong. So once we shorted over here, we could have placed a stop loss somewhere over here. So in case price went on to break that high, I know where to exit and cut short my losses. And what would be my target? The target would be the vertical distance from the highest point of the head, which is this. So that distance I'll subtract from the breakdown point. So my target would have been somewhere over here. But as you can see in this particular case, there was a very precipitous fall in the price of Hindalco. So this head and shoulder turned out to be a major reversal pattern. In this particular case, we had a very dramatic decline. So this is how you kind of trade head and shoulder. Another thing to see over here is that look at this particular low point. Now that particular low point is coinciding with this high point. So what we have is a former support level which acted as a resistance over here. So we have a former support holding as a resistance. So price did not cross above that support level, and then we had a dramatic decline. So what you see over here is the change of polarity principle, wherein a former support is acting as a resistance to price, a concept that we spoke about earlier. Now over here, we have the weekly time frame chart of Brent crude, which is one of the most widely tracked grades of crude oil in the world. So there are two grades of crude oil that are very widely tracked. One is WTI, which is the US benchmark, which stands for West Texas Intermediate, and the other grade is the Brent, which is typically called the global benchmark, that is produced in the North Sea. So anyways, we'll not get into the types of crude oil. The objective is to show how a head and shoulder pattern acted over here. So in this case, there was a rally, then a decline, then price started rallying again, came down, made a low somewhere over here, started rallying. The moment you had two identifiable lows, once price started rising from say this point, the moment you had two lows that could be identified, you could draw a straight line connecting those lows and extend it into the future. In this case, as you can see, the price did not break above the previous high. It made a high over here and then it gradually started declining. So what you have is a lower high. And before this break occurred, you could kind of see that a head and shoulder is forming. This is the left shoulder. This is the head. And this is the right shoulder. And this is the trend line connecting the lows of the two shoulders. The moment that trend line broke over here, you can see that there was a very dramatic decline in the price of crude oil. So again, how to measure targets? The targets could be measured by subtracting the vertical distance between the high of the head, which is this point, all the way down to the neckline. So that vertical distance will be subtracted, from the breakdown point. So you'll subtract that distance from this point. And in this particular case, the target was more or less achieved before price started heading higher. Let me talk about, in this particular chart, you could also have used other tools. So for instance, you could have drawn trend lines. So you had one important high over here. You had the next high over here. So you could have connected those two highs to draw a trend line. And somewhere over here, you would see the price breaking above that downtrend. So what that tells you is that once the price breaks, crosses above the downtrend line, the downtrend has probably ended. And going forward, you could have you could have a move higher. Similarly, you could have drawn a trend line from this low as well. This was another identifiable low. So you could have drawn a trend line connecting this low to this low and then extended into the future. So that is how you can draw trend lines. Similarly, you can draw trend lines. You can draw intermediate trend lines as well. Something like connecting this low with this low. So if you draw a trend line connecting this low with this low and extend it into the future, eventually, as you can see, price broke that trend line and there was a dramatic, sell-off. So what I would suggest you is whenever you start using charts, get into the habit of drawing trend lines on the charting platform that you use. So no matter what charting platform you use, trend lines are a tool that are provided by all charting platforms, and feel free to explore, to get used to drawing trend lines, because that pretty much forms the base of technical analysis. As a chartist, you must know how to draw trend lines. With experience, you will get better at drawing trend lines. You'll get better at identifying when not to draw trend lines and stuff like that. So once you start using charts in the real time, get into the habit of drawing trend lines, connecting important lows or important highs. And the sooner you get proficient in drawing trend lines, the sooner you'll learn various aspects of technical analysis, because trend lines pretty much form the base of everything in technical analysis. So I would highly suggest you to start drawing trend lines. So just like head and shoulder, there are various other patterns as well. Of course, it's not possible to talk about all of them today. Later, I'll tell you a link where you can, kind of study the various patterns in detail. But now let's proceed to something that's called technical indicators. Now, when you start using charts, when you start practicing technical analysis, either for making trading decisions or investment decisions or portfolio based decisions, you will start using technical indicators as well, which are nothing but derivatives of price or volume. So technical indicators are either a derivative of price or volume. There are hundreds and thousands of indicators out there, but these are some of the most popular and time-tested indicators that almost all charting platforms provide. So you have moving averages, something that's called relative strength index, which is a massively popular indicator and one of the finest indicators out there, provided you use it well. Then you have something called MACD, which stands for moving average, convergence, divergence, rate of change, stochastics, Bollinger Bands, DMI or directional movement index, ADX or average directional index, parabolic SAR, where SAR stands for stop and reverse, ATR or average true range, Ichimoku cloud, OBV or on balance volume, and CMF or Chaikin mini flow. So these are some of the most popular and time-tested technical indicators used by chartists, and indicators that are provided by virtually all trading platforms. So feel free to start learning about these indicators as you gain experience in technical analysis. Again, it's not possible to talk about all indicators because indicators by themselves are very vast. In this particular case, I'll just talk about moving average, which is one of the most simple, which is one of the most oldest, as well as an indicator that works very well. The reason why I'm using moving average is because I want to keep things simple, and moving averages are one of the simplest indicators that you could come across. So let us get started. So, as I said, moving average is one of the most widely used technical indicator. All the charting platforms do provide moving average. Now, there are various types of moving averages, but the three most commonly used moving averages are simple, weighted, and exponential moving average. No matter what moving average you use, as the name suggests, a moving average is nothing but an indicator that displays you average price of a security over the past n periods. So if you're, let us say, if you're plotting a 10-day moving average, then that indicator will display you the 10-day average price of the security. What is the average price over the past 10 days and so on. However, it's not just plotted as one point, but rather it's plotted as a continuous line on the chart. So as you can see over here, a moving average is a continuous line that is plotted on the chart. Uh, so it keeps, as new data keeps coming in, the moving average will also keep moving roundward. So it's plotted as a continuous line. Now this is the example of, now first of all, let me talk about why is a moving average used. One of the primary reasons why moving average is used is to determine the trend of the security. So as in this case, if you see, moving average also smoothens out the data. Look at how smooth the moving average is. If you look at the price, there are too many ups and downs and ups and downs. But look at moving average, it's very smooth. That's one of the major reasons why moving average is used, in order to smooth out the data and eliminate the noise from the market. So one of the reasons why moving average is used is to smooth out the data. And the moment you smooth out the data, as you can see from this chart, it becomes very easy to identify trend. So in this particular case, initially the trend was up, then it's the trend was down, and then from this point onwards, the trend has been up. So forget about the price, just look at the moving average. You will see that by smoothing out the data, it makes identification of trend quite simpler. So that is the primary objective why moving average is used, that is to smooth out the data. And of course, moving average is used to determine the trend of the security. So whenever moving average is trending higher, as in this case, it tells you that the security in general is trending higher. Similarly, when a moving average is trending lower, it tells you that the security is trending lower. So the primary objective of moving average is to identify the trend of the security, the general direction of the trend of the security. Oh, sorry. The next objective, the next major objective of using a moving average is to identify areas of potential supports and resistance. So as in this particular case, you can see, once price broke below the moving average, it started trending lower, then it started trending higher. For a few days, the moving average sort of acted as a resistance. Price, after this nice rally, it started hovering near the moving average for a few days, which tells you that the buyers and sellers are kind of unsure in terms of what to do next. But eventually that indecisiveness ended when the price started trending higher. So now you have a situation wherein the price is trending, wherein the price is above the moving average. Going forward, if you see, look at how well the moving average acted as a support. So this decline halted right near the moving average, and then what we had was a major rally that came in. In this particular instance also, if you see over here, the decline from this point halted right at the moving average before you had a very strong rally. So one of the reasons why moving average is used to identify areas of supports and resistances. And as you know by now, supports are areas where you would look at buying opportunities. Similarly, resistances are areas where you would try to identify selling opportunities. In this particular case, see that moving average is acting as a support. So you could have bought the security over here and look at how powerful the rally was. Similarly, the moving average was tested over here and price started trending higher. Once the moving average acted as a support and price started trending higher, it tells you to buy the security. So whenever price is touching the moving average from above, it tells you that the moving average is acting as a support, and it kind of tells you to buy the security in question. The role would be opposite if price is below the moving average and that moving average is acting as a resistance. Now in this particular case, if had the price tested the moving average, but instead of going higher, had it started declining, then it would have guided you to sell. So when price is below the moving average and when moving average acts as resistance, that is an area where you would look to sell. Similarly, when price is above the moving average, and the moving average acts as a support, that is the region where you will look out to buy. So using moving averages, buy and sell signals can be effectively generated. So as I said, identifying supports and resistances, which will permit you to identifying areas where you can buy and sell. The third is generating crossover signals, which I've already talked about. So for instance, when price is trading below the moving average, going forward, if the rise in price causes the moving average to break and price, if it moves above the moving average, you should be on the lookout for buying opportunities. So whenever a moving average is tested from above the price, you would look out to sell. Similarly, whenever a moving average is tested without being broken from below, you would be on the lookout for selling opportunities. So that is how you can kind of trade moving averages.
Abhishek, one quick question that is coming from Sukanya Chakravarti is, why do you start to draw the moving average line from a particular point? Is there a rule that the moving average should be drawn from a certain point? Maybe you can clarify just how a moving average is generated, so it'll be easy.
Right. So moving average, as I said, is a technical indicator that is plotted by the system itself. You don't need to draw a moving average. Later, what I'll do is, just for, a couple of minutes or maybe 5 minutes, I'll show you how to plot a moving average. All that you need to do is you need to go to the toolbar section. You will have moving average over there. Select that, and the computer will automatically plot the moving average for you. Unlike a trend line, which you need to draw, moving average, you don't need to construct it by yourself. The system would do it for you. So moving average is automatically constructed by the system, unlike a trend line, which you need to draw using the toolbar. So I'll show this later towards the end of my presentation. So does that kind of clear the doubt? Okay, so I would take that as a yes. So that's how you kind of trade moving averages. Now, no indicator, there is no indicator that only has advantages and no disadvantages. Every set of indicator has some advantage, has some disadvantages as well. Now, what is the disadvantage of moving average? Well, the disadvantage of moving average is that it is a lagging indicator. So as you can see, initially moving average was trending higher, but see that by the time it started trending lower, the price had already declined too much. So at this point, if you look, price was already here. So by the time moving average changes direction, a lot of move could already have happened. So that is one major drawback of moving average, the fact that it is a lagging indicator. The other drawback of moving average is that a moving average is a trending indicator. That is, you use moving average when the security is either trending up or down. In this particular case, we had a security that initially trended down and later on started trending higher. So we had a security that is trending either up or down. That is where moving averages can be used. Having said that, if the trend of the security is sideways, then moving averages could prove to be less useful, because there could be a lot of whipsaws around the moving average. So if you have a sideways trend, wherein the price is just trading this way, it's going up above moving average, coming down below moving average, and if it's just fluctuating that way, a lot of false signal could be generated. So you need to know when to use moving averages. You should not use it in a market that is sideways. You should only use it in a trending market. So the two major drawbacks of moving average is that it is a lagging indicator, number one, and number two is the fact that it is not as useful when used in a sideways market. However, the advantages of moving averages more than outweigh the disadvantages. So, once the security starts trending, moving averages can be an excellent tool to trade, as was shown over here and over here. So in a trending market, moving averages is a lovely tool to trade securities. So again, there are various indicators out there. If you go to your charting platform, you will see that there are thousands of technical indicators. It's not practical to use all of them because a lot of them are custom made by individual users. But these are some of the most widely used technical indicators which have, which have been tested for the past several years and have stood the test of time. So these are some of the most reliable technical indicators that you could think of studying and applying when you start using technical analysis. Okay, now as I said earlier, technical analysis is not just about prediction. You don't use technical analysis just to predict where the price could head into the future. One of the other equally major utility of technical analysis that it is an excellent tool to manage your risk. Something that's very difficult from a, say, fundamental analysis standpoint. Now, fundamental analysis will not help you much in order to manage your risk. But technical analysis is one such tool which will help you dramatically in managing your risk. The events of 2000 wherein the dot-com bubble occurred, the events of 2008 wherein the global financial crisis occurred, and then again of 2020 wherein the COVID-19 crisis occurred. The movements, the decline in stock prices and prices of other securities were very dramatic. So those are instances wherein you would need technical analysis to manage your tools, to manage your risks very well. So another critical utility of technical analysis is risk management. Remember, trading or investing is just one half of the equation. The other half of the equation is managing your risks efficiently. If you do not manage your risks very well, then you could, kind of blow up your invested or tradable capital within days. So you must know how to manage your risk very well. You must be able to control your emotions very well. Now, the two basic emotions are fear and greed, right? In a bull market, that is in a market where price is moving higher pretty dramatically, it is easy to get greedy because the price is just going up, up and up. So it is very easy to buy securities at obscenely high levels. Now, there is nothing wrong in doing that, provided you manage your risks very well. Once you take a position, that just completes one half of the picture. The other half of the picture is you should know when to exit your position, both in situations wherein you're making money as well as in situations you're making a loss. You need to know where to exit. That is the other half of the equation. Again, one of the principles that I strictly adhere to is the fact that whenever you deploy a certain capital to trading or investing, let us say you have say 50 lakhs in your savings account, out of which you decide to allocate 20 lakhs for the purpose of investment in the stock market or for the purpose of trading in the stock market. Your foremost objective once you deploy that 20 lakhs is that you need to protect that 20 lakhs. So your ultimate objective should be to protect your capital. That is, the return of capital should be a very critical aspect of your objective. Return on capital, which is nothing but making money on the capital deployed, that comes later. The ultimate objective is to protect the capital that you have put in, and making money on it is just secondary. So your foremost objective should be to safeguard the capital that you have deployed. Trust me, if you put, let us say, 100 rupees into the market, and initially if you see a drawdown to say 50, let us say the 100 rupee capital that you put into the market, it declined to 50. What has happened is that there is a 50% drawdown from 100 to 50. But then going back from 50 to 100, you need to make a gain of 100%. So to reclaim that same loss, see the difference. Initially, there is a 50% drawdown, but to make a gain, but to recover that drawdown, you need to gain 100%. Now, that's a task that's very difficult. So, safeguarding your capital is a very, very important part of, managing your risks effectively. And technical analysis will help you in doing that, provided you stay disciplined. Now, these are some of the important guidelines that I use myself. I keep remembering myself whenever I trade.
Abhishek, before you get into that, I'm so sorry. I just want to relay a couple more questions to you. If you're able to see the chat, you'll see the questions as well. So one is to do with moving average. Will using a lesser period for a moving average help in assessing the trend faster? That's question number one. I'm sorry.
Yes, you can do that. As I said, there are different time frames on which the chart could be based. You could use something like the 1 minute chart. You could use something like the 10-minute chart. You could use 1 day chart, 1 week chart, 1 month chart, etc. Again, it depends on what is your objective. If your objective is to enter a position and exit on the same day, that is, if you're a day trader, then you'd be using shorter time frames, and naturally it follows that you'd be using moving averages on shorter time frame charts. So if you're a day trader, you'd be using something like, say, a 10-minute chart, and you'd be deploying moving average on the 10-minute chart in order to execute a trade, in order to make buy and sell trades. So the time frame also depends. So for example, if you're an investor who has bought in a security whose objective is to hold on to a security for, say, 10 years, then you'll be using moving averages on monthly charts, right? Now, again, it's difficult to say, explain like this. I'll show you in a real world chart later on. Within a particular time frame also, you could alter moving average. So let us say you're looking at the daily chart. So within daily chart, you could use an N period moving average, where N could refer to anything. It could refer to 10-day, it could refer to 20-day, it could refer to 50-day, it could refer to 200-day, and so on. Now, the larger that number is, the larger will be the moving average, and the more smoother will be the data. Now, as I said, it's a little difficult to explain this way. I'll show you in the last 5 minutes. I'll explain you using a live chart how to use moving averages. I mean, how to read moving averages.
Thanks, Abhishek. Next question. Is it possible in technical analysis that two different tools give different indications of buying and selling? And if so,
yes.
how and on which indicator should we rely? And how will we get the answer? This comes from Swati.
Yes, so there can be situations wherein you're using, let us say, 5 indicators, of which 3 are telling you that the trend is bullish, but the other 2 are not pointing out to bullishness. So what you have is a sort of mixed signal. Now, one way to avoid this is that, especially for those who start trading and start learning technical analysis, at start, there is a craze to use as many indicators and as many tools as possible. Now, I would avoid using that. At most, you should use 2 or 3 indicators. The reason being that the larger the number of indicators you use, the larger could be the conflicting signals that they generate. And the only thing that they will do is end up confusing. So keep things simple. Use 2 to at most 3 indicators. And I would again suggest you to use those indicators on which you have a very good understanding of. Try avoiding using those indicators that you don't understand very well. Use only those that you do understand very well, so that you will be able to make changes in the settings parameters of each indicator, and you would know how to act. So if you're a beginner, don't use multiple indicators, just use 2 or 3 so that there will be less confusion.
Abhishek, with this kind of a similar question has come in, which is the most suitable indicator in technical analysis?
Again, there is no definite answer to this. There's no definite answer to this. It really depends on the indicator with which you're most accustomed to, the indicator which you have studied the most, and the indicator that you have applied the most. There's no definite answer to this. See,
so depth is more important than just knowing the name of an indicator, right?
Yes, you should know how to use that indicator very well. That is the key. If you don't understand the indicator very well, don't use it. And again, there is nothing like, this indicator works better than this. There is nothing like that. It completely depends on the level of expertise that you have on that indicator and how comfortable you are with that indicator.
Another question is how to select the most efficient indicators. I'm just adding these questions because they're relevant to what you are saying right now. Soham
Again,
Majumdar has this question: how to select the
right.
most efficient?
Again, as I said, there is no answer to this. There is nothing like, this particular indicator is the best indicator or that particular indicator is a horrible indicator. There is nothing like that. It completely depends on, on the expertise or the command that you hold on that indicator. So these, if you go to a charting platform, you will see that there are more than 200 or maybe even 500 indicators. Of those, these are, some of the most reputed. So what you could do is, gain a brief understanding of each of these indicators, and then see which indicator suits you the best. And again, one thing you need to keep in mind is that no two indicators will work alike, because the market conditions can infer your decision in terms of what indicator to use. Like I said, in case of moving average doesn't work so well in a sideways market. Now, this is the indicator that you should not be using if the market is sideways. On the other hand, if the market is sideways, you could use something like a relative strength index. For example, a relative strength index is it's a very versatile indicator in that it could be used in a trending market as well as in a market that is sideways. So one of the indicators that you could use in a sideways market is a relative strength index, but moving averages is a strict no-no in a sideways market. So you should know which indicators to use when. There is nothing like an indicator that works, that works well in all sort of market conditions. No, that's not the case. You must know which indicator to use when. So you should be very versatile in terms of adapting to which indicator to use depending on how the market conditions. Now that you will only realize when you start learning about each of these indicators.
Thanks, Abhishek. No more questions.
So yeah, we were in. So these are some of the principles that I religiously follow even today, despite being in the markets for the past almost 12 to 13 years. These are the principles that I strictly follow, and I would suggest you to follow as well. One is, whenever you enter a trade, don't just look at the reward side. More important to me is look at the risk side. What is the risk? So whenever you enter a trade, reward is secondary. As I said, what is important is protecting your capital. So managing your risk is primary. So the first thing that you need to do is, whenever spotting a trade, what will be the exit level? What will be the level at which you'll exit the trade? That you need to identify. Second, stop losses are very important. Now, what is a stop loss? Stop loss is a level at which I'll exit my trade in case my trade turns out to go wrong. So let us say I buy at 100. Now, of course, if I bought a security, I would want the price of that security to go up because I would want to sell it at a higher price. But what if, instead of going higher, if the price starts declining? Let us say I buy at 100, but instead of going higher, the price started declining and is now at 98. So I'm on the wrong side of the trade. I'm making losses. So I should know at what level I'll decide to exit from the trade and accept that my trade has turned wrong. So stop losses are nothing but the level, a particular level wherein you exit your trade in case it turns out to be wrong. So let us say I buy a security at 100. I might place a stop loss at say 96. So that is the level wherein if the prices touches that, I will exit my buy trade. So stop losses are extremely, extremely important. Don't even think about trading without a stop loss in place. Then if you place the stop loss, and in case the stop loss gets hit, then I would advise you to exit the trade. Now, what happens is that, let us say you buy at 100, you place a stop loss, you place a mental stop loss at 96, the price starts declining, but the moment it comes to 96 and touches it, emotions come into play. You may feel like, oh God, I'm not going to exit my position at a loss. And you may have that urge to hold on to the security on the basis of hope that the price will eventually come back to 100 and better yet rise above it. Now, the moment hope comes into play, that is the time when your losses could magnify. So if the stop loss that you had determined previously, if that is hit, exit the trade without a second thought. Don't even think of holding on to a security forever. That could be a very disastrous decision. Again, don't let emotions get the better of you. Now, the basic emotions when it comes to market is the emotions of fear and greed. So when you're making money, greed could come into the picture, and when you are making losses, you may hold on to those losses on the basis of hope. So avoid that. You must know when to exit from a position, both when you're making profit as well as when you're incurring losses. Now, another rule that I follow religiously is never to revise stop losses against the direction of your trade. Uh, what I mean by this is, let us say let us use that same example again. I buy a security at 100, and when I bought at 100, I decided to place a stop loss at 96. Let us say the market starts coming down, approaches towards 96. The moment you see the price approaching towards 96, then you revise your stop loss to 94. No, don't do that. Never revise buy stop loss low, because in that case you could keep on doing that forever, and you could incur huge losses. Then cut short your losses, let the profits run. So if you have trades which are not working as expected, wherein you are making losses, it is better to accept defeat and exit from those trades rather than seeing your losses becoming bigger and bigger. Similarly, you could let your profits run by trailing your stop losses in the direction of the trade. So what happens is, let us say I buy a security at 100 for a target price of 110. So let us say the price has rallied from 100 to 108. So what is happening is I'm making 8 rupees profit. Now, let us say I previously decided the stop loss at 96. But because I'm making an 8 rupees gain, I can revise my stop loss higher. So instead of 96, I can bring it to something like 105. So I bought the security at 100. My target price is 110. The current market price is 108, and I've revised my stop loss to 105. So what happens is that from 108, even if the price starts declining and hits 105, you would be exiting the trade, but still you'll be making a 5 rupee profit. So you let your profits run and keep trailing stop losses in the direction of the trade, so that you don't suffer losses. Then again, lastly, focus on risk to reward ratio. This is also very important. I would suggest a risk to reward ratio of at least 1:2. What that means is, for a risk of 1, you should have a reward of at least 2. So if you're risking, say, 2,000 rupees of your capital, then your reward on that trade should be at least 4,000 rupees. Anything less than that should ideally not be accepted. Now, again, this is another chart. Now, this is a very old chart. This is a chart that dates back to 2017. So as you can see, now this is a chart of the Nifty PSU index, PSU bank index, which comprises stocks, an index that comprises of banking stocks from the PSU sector. So you have the likes of SBI, PNB, and those banks within this index. So initially, you see the price was trending lower. Then here, price bottomed out, started trending higher. Then look at what happened on the following day. There was a huge gap. That is, on the following day, price opened way above the high of the previous day, and there was a very strong rally. Now imagine if you're short on the position and you're stuck on the wrong side of the trade. I mean, the losses could have been very detrimental. So now, of course, there is no way to avoid this, because this is a gap between the close of one session and the opening of the following session. So there's no way to avoid this. But the moment the market opens, even if you're on the short side, you should be willing to exit that short position. Had you not exited, look at how catastrophic your losses could have been, because there was a very strong rally in the price within just 1 to 2 days. So this chart is one of my favorite charts in terms of explaining the concepts of risk management. You need to manage your risks very well, otherwise you could see your capital being destroyed within days. And these are some of the rules that you could just glance through. Now, these are the rules set forth by Martin Pring, who is one of the most noted market technicians in the world. He's one of the most followed and one of the most renowned technical analysts in the world. He has written a lot of high-selling books. One of the books that I would suggest of Martin Pring is Technical Analysis Explained. That was a part of the CMT curriculum when I was pursuing my CMT. He is, explained the concepts exceptionally well. So this is one book that you could consider. You could quickly glance through, the trading rules provided by Martin Pring, and these are, the gold standards. I would say, these are exceptionally sound trading, risk management, and money management rules. So this is not my rules. This is a rule set forth by Martin Pring. So you could quickly glance through them.
Abhishek, another question here. You mentioned in the case of risk management that we should never revise our stop loss. But in case our target does not, if the price does not reach our targets, should we revise the target?
If price does not
reach the target, so you said that you should not revise stop loss, right?
Yes. Targets you can revise. Targets you can revise.
Yeah.
You see. It's not that you should not revise your stop loss. It's just that you should not, for example, let us say you have bought a stock at 100 and you place a stop loss at 96. If the market starts declining and approach towards 96, now don't revise your stop loss lower. That is, don't go to 94 or 93 or 90. You can, for a buy position, you can revise stop losses higher. So from 96, you can bring it to 98, but never take it down. So that is the thing that you need to remember. As far as rewards are concerned, as far as target prices are concerned, that you could revise in either direction. You could revise it up or you could revise it down. But for stop losses, never revise against the against the trade. So if you are long, never revise stop losses lower. While if you're short, never revise stop losses higher. Yeah.
Thanks.
Any more questions?
No, all good at this point.
Yes, one question is come. The Shomik Chatterjee. Which indicator do you use while the trading in short term?
Again, see, technical indicators are universally applicable across time frames. What differs is the time frame of chart that you are referring to. So let me, quickly go through. Just 1 second. What screen are you seeing right now?
We're seeing to learn in detail about technical analysis and other. It's your PDF file.
If I want to show Google Chrome,
click back on the share button.
1 minute.
Abhishek, what we could do also is if it's becoming a problem, is that Prasenjit, when he covers this session, because he'll be showing live charts, he can cover this as well. But the idea that you were trying to convey is that basically technical analysis is fractal in nature. So what works in short time frames will work in longer time frames as well. When you think of, if you see using a daily price chart and you got a 7-day moving average, you can also use a minute.
Are you able to see?
Yes,
are you able to see? Are you able to see Google Chrome? You're able to see the charting terminal, right?
Yes.
Okay. So as you can see, there are various tools available. So in order to draw a trend line, you just need to click on trend line. Of course, here I'm using Fire's charting platform. So the platform, the interface may vary, but you just need to click on, say, trend lines in order to plot that. Let me just remove the magnet. You just connect important lows, something like this. That is how you draw a trend line. Okay, I'm just randomly drawing over here. Let me just take the daily chart. Now, as you can see, these are the time frames that charting platforms provide. So this is the Nifty 1 minute chart at present. So as you can see, each candle reflects the price action for each minute. So if you look at the x-axis, you will see time being displayed because these are very short-term charts. But if I go to daily, now if you see what you have is each candle reflecting the price action of 1 day. So you have a slightly longer term chart. So if you see, you will see months below, something like March, April 2021, and so on. Likewise, if I go to 1 minute chart, now you have a very long-term chart. So right from 2012 to present, you have a very long-term chart. So that is how you kind of connect trend lines. If I want to draw a trend line, I could connect highs as well. I'm randomly drawing. I'm just showing you how to draw trend lines. So first you need to identify 2 points. In this case, the 2 points were over here. Then we had another point somewhere over here. So, you could just connect, you could just identify those 2 points and then draw a trend line passing through that. So that is how you could draw trend lines. Secondly, moving averages. Okay. Now, in order to plot technical indicators, I'll just go to the indicators tab, which is over here. So as you can see, there are lots of indicators. There are hundreds of indicators available. Let me just put in moving average over here. Within moving averages also, if you see, there are tons and tons of moving average. I'll use the simple moving average, which is referred to as just moving average. I'll click on that. The moment I click on that, see a moving average is plotted. Now, what is this moving average? Let me just show you. I'll just double click on the moving average line. So here what we have is a 9, of course, we are on the monthly chart. So this is the 9-month moving average. So this is nothing but the average of of rolling 9 months. So this is a moving average on a rolling basis. It shows you the average of 9 months. So if you go on the daily chart, it will show you the average price of 9 days. If you go on 1 minute chart, it will show you the average price of last 9 minutes and so on. Within a particular time frame, also you could change the length of the moving average. So instead of 9, I can take something like 200, for example. So this shows you the 200-day moving average. Now the difference between a 200-day moving average and let me also plot a 9-day moving average, for example. If I plot a 9-day moving average, now I guess this is 9. Let me just see. Now this is 9. So if you see, the 200-day moving average is very smooth. However, if you see a 9-day moving average, it is quite volatile. So the length of the moving average also tells you about the sensitivity. So if you're using a long moving average, it will be very smooth. If you're using a short moving average, it will be more volatile. Let me turn this to 30. So this is more volatile than 200, of course, but if you see, this is less volatile than 9-period moving average. So that way, you within a particular time frame as well, you could change the tenure of the moving average. Now, currently, where is Nifty? The Nifty is currently at 15,175, and the 200-day moving average is somewhere over here. So at the present juncture, 200 moving average is pretty meaningless because the current price is way above the moving average. So I would, for trading purpose, I could prefer something like, say, a 20-day moving average, because it will be more closer to the price, or a 50-day moving average, which will be slightly more closer to the price. So look at how, in this particular case, look at how well the 50-day moving average acted as a support here. And again, see how well it acted as a support over here. Again, as I said, in a sideways market, moving average can produce a lot of false signals, because see, this is a market that was typically sideways in this particular period. Nothing much is happening. So you're seeing price constantly fluctuate above and below moving average. So in a sideways market, moving average is pretty useless. So that is how you can plot your moving average. So if you're a short-term trader, let us say you're an intraday trader who believes in taking position today and exiting today itself, you could refer to something like 5-minute chart, and you could alter the moving averages as per your tastes and preferences. Again, see how moving average is acting as a support in this instance as well. The key to note is that the security in question must be trending. You can't use moving average in a sideways market. So look at how well the moving average is. Look at the signals that moving averages provide in a trending market. So it's an excellent tool, provided you know how to use it, and you should know when to take a trading signal and when to ignore.
Abhishek, there are a number of questions coming in. A number of these can, in fact, be taken by possibly the next session as well. One question that I would suggest that you take is from Swati. If a company is fundamentally strong and we have bought the stock at a high price and the price is falling, then in that case, what should we do? Should we hold it, or should we and keep averaging the price, or should we exit? This is the
see if you're that again depends on the sort of time frame on which you're trading. If you're a long-term investor, if you're trading for say 5 years, 10 years, then you shouldn't be worried about short-term fluctuations in price. However, if you bought a particular company on the basis of fundamental, but if your holding period is say just 1 year, then even a 3 month of decline could have severe repercussions on your capital. So it really depends on the time frame for which you are trading.
Thanks, Abhishek.
That way. So this is how there are again various indicators. Also, I just showed you trend lines. Trend line is just one price tool that you can use. Similar to a trend line, there are various other price tools as well. So you have pitchfork, you have Fibonacci retracement, Fibonacci extensions, you have GAN. All these tools are relatively complex, but are quite widely used. So it's a very vast subject. Technical analysis is a very vast subject. You can't become a master of all indicators and all price tools. Just stick to the one that works best for you and on those that you have the most proficiency. And of course, I would again remind you to, very strongly follow the risk management principles. Don't even think of trading or investing without having in place sound risk management strategies. That forms the benchmark of trading and investing. Without risk management, it's simply not worth it. That way.
Thank you so much, Abhishek.
Thank you. So again, if you want to learn about financial markets, you could visit our website, which is fires.in. So we have a portal called School of Stocks, wherein we have extensively talked about various aspects of the financial markets. So technical analysis is one such module, which we have talked pretty much in detail. We have covered other asset classes as well. We have covered commodities, currencies, options, futures, intermarket, risk management. So if you're interested in learning about technical analysis or other areas, you could visit this link that is mentioned in this particular slide. Oh, sorry, you're not able to see that, right? I'll have to switch, I guess. 1 minute. Yeah, let me just switch. Yeah. So this is just a snapshot of School of Stocks. So we have 10 modules as of now, with the 10th module is still ongoing, but the first 9 modules are complete. So you could we have written extensively about technical analysis as well. So you could visit this link if you're interested in exploring further about technical analysis, or if you're interested in exploring further about financial markets in general. So that's it. I hope you find I hope you found today's session quite useful, and I hope that I was able to explain the basics of technical analysis pretty well. I hope you found it useful. In case you have any doubts, you could write to me on my Twitter handle, which is @ABChinchalkar. You could follow me on LinkedIn as well, and I would be happy to address any queries that you have relating to technical analysis or about financial markets in general.
Thank you, Abhishek. Such a wonderful presentation.
Thank you so much, sir. My pleasure. And really happy that you provided me an opportunity to give this introductory session. So it was my pleasure, sir.
Really such a wonderful presentation. Such a simple manners. And I hope that all the students will learn more from this.
Thank you so much. The pleasure is mine. And thanks to Joel as well for providing this opportunity.
Always a pleasure to have you on board, Abhishek. It's always fun as well.
Thank you so much. Thank you so much, Joel.
Great.
So
now,
I'll stop sharing.
Yeah, I've already, in fact,
it stopped, right?
To share my screen. Yeah, so
Okay.
so you can, in fact, if you want to mute as well. If there are any future questions, I'll be happy to relay them to you as well. Thank you so
But
much
you could
once
send,
again.
you could send a list of questions if the students have, or they could directly send a message to me on my Twitter handle or LinkedIn. That will suit.
That's perfect. Yeah, that's perfect.
Thank
Could
you
I
so
come
much,
in?
everyone.
Could I come in for a minute?
Yes,
Professor
sir.
Sogoto?
Yes. Actually, Joel and Abhishek, this is our academic day.
No. First, my apologies for joining about 10 minutes late. Because of some urgent. Joel as well as to Mr. Abhishek. There is a lot of interest among a core group of students to understand the technical analysis in a little more detail, in a little more advanced fashion. Is it possible to organize maybe a slightly more advanced course in technical analysis at some future date convenient to you? That will not
yes,
be for a
Professor.
large audience, but it will be for maybe 15, 20 students maybe.
So we can work out something along those lines. That's as part of the academic partner program. In fact, what we could also do is create opportunities for a few CMT charter holders, subject to time available, to conduct a short course on campus as well as a visiting faculty also. That's something that we can work.
Okay, thank you. Thank you for that.
So in fact, I'm hoping that, like you said, it's rather than 15, 20 students, after I'm done with my piece of the presentation, hopefully there'll be 50, 60 students who are keen on this. Once they're able to see what kind of career opportunities open up through understanding the discipline of technical analysis. But it can be done. It's definitely eminent to do.
Yeah. But I must say, very nice session. Compliments to you.
Wonderful.
Very nice session. Yeah.
Great. And I'm quite
Thank you so much, sir.
enjoy the rest of the day as well. Abhishek has always been a very generous volunteer for the association, reaching out to students, kind of engaging with them, which is how also in his role as the head of education for Fires, he's been putting out very interesting content. So please do visit fires.in School of Stocks. You can just search it on Google and you'll find it. And yeah, so great. That's it. Thank you so much, Abhishek.
Thank you, Joel. Thank you, everyone, and happy weekend to all.
Have a great day. Okay. So, shall I continue, Professor Lata? Professor Lata?
So I think, Sogoto, could I just inquire, the afternoon session will be...
So are you able to hear Professor Banerjee?
Can you repeat once again?
Yeah, I think there is also a session scheduled at 2 o'clock, isn't it?
Yes, sir.
That is correct.
Yeah. So that 2 o'clock session, who will be there? Who will be taking that?
That is another CMT charter holder, Prasenjit Viswas.
Okay, Prasenjit. Yeah.
That's
Okay. So fine, fair enough. Fair enough. I just wanted to know.
Wonderful.
Okay.
So great. Now we have about 35 minutes to go in this session, and I had budgeted about an hour. So obviously I'll skip a few major chunks, but this is maybe something we can take up in a future session as well. But I just wanted to quickly talk to the students of who are online right now about the perspective of career opportunities from learning of the discipline of technical analysis and what kind of careers can you prepare yourself for. There was also a section on trading psychology, which I'll maybe touch upon a little briefly, but I'll try to move a little more quickly through this session. So I mean, this slide I usually have just because I like this picture very much. But the question is, why are we here? What are we talking about? We are talking about, like I mentioned, a quick overview of the financial services industry, where technical analysis fits in it, what kind of careers there are through the practice and study of technical analysis, and what is the space of the CMT Association, and by extension, the academic partner program that IEM is on board with us for, and what does that entail for you students who want to learn more about technical analysis. Who am I? Professor Shavato did tell you a bit about me as well yesterday. Abhishek brought up mention of Martin Pring, the author of 26 plus books. The person on the extreme left hand side is Martin Pring. The person in the center is Ralph Akampora. He is one of the founders of the CMT Association. So he was responsible for the start of the association about 50 years ago. And this is just a quick graph of my career, but like I said, Shavato has this was me. So if you have not been able to tell, it's just with lesser hair all over. Right. Right. What is the CMT Association though? This organization that your institute has partnered with, why has this partnership come about? And what does the CMT Association do? Maybe I'll talk to you a little bit about that as well as we go along through the course of my presentation. So the four things that I told you I'll talk about: technical analysis, the CMT Association, careers in finance, and careers enabled by technical analysis in overall the financial services industry. I'll touch upon all these areas. CMT Association is the world's foremost, and both these terms in the center are important: credentialing and advocacy. So simply put, anyone who has the CMT charter and the letter CMT against their name, you typically has studied and cleared the 3 levels of the CMT program, which is the world's most rigorous or the world's most respected body of knowledge in the world of technical analysis. Right? And advocacy is the work that we do in working not just with educational institutions like yours to help encourage the learning of technical analysis, but we also work with employers so that students like you, when they go into their careers, have job opportunities waiting for them in the right places, right? And we also work with regulators like the Security and Exchange Commission in the US, SEBI in India, Monetary Authority of Singapore, and so on and so forth, to be able to create a financial market conducive to the study and acceptance of technical analysis as a meaningful method for risk management, investor education, and investor protection. Right? What is the story of the CMT Association? What is in fact the story of technical analysis as well? And now, technical analysis in its first rawest form was in fact practiced in the early 17th century when lottery prices in England were plotted, but a more formal study began in the rice markets in Japan in the late 18th century. The late 1700s means the late 18th century. Right? The Western world learned more about it when Charles Dow began to write some. Now you will hear, if you haven't already, about the Dow theory in financial markets. So Charles Dow is known as the father of kind of modern technical analysis in the Western world. And he wrote a few treatises, and a number of developments have happened around that. 1969-74 is important because Ralph Akampora, who you saw with me in the picture, first got together a group of technical analysts to talk about what is the latest in the field and what people can do to learn more, grow better. This began in 1969. And in fact, what is interesting is that both the CFA Institute and the CMT Association grew out of what was then called the New York Society of Securities Analysts. So folks who were practitioners of fundamental analysis, who focused on specific sectors, formed their own kind of sector-based groups, and the technical analysts who could look at all sectors, all markets, formed a group of their own, and that is how the CMT Association, then called the Market Technicians Association, was born. The CMT designation came about 10 years later. So in 1969, the first meetings began. In 1974, it was formally incorporated as an association of members. In the US, this is a non-profit organization. It's what is called a 501c6 type of organization, an association of members. Right? So as the reputation of this association of members began to grow, in 1985, it was decided that there should be kind of a standard for entry into the group as well. So the CMT designation and the exams were born then. So that if you want to be part of this elite group of market technicians, of technical analysts from around the world, and by then people around the world have begun to discover the group and want to be part of it. So this designation was created so that you need to earn this designation to be part of this group that is constantly committed to growing more and more. 2005 was the landmark year because the SEC, that is the regulator in the US, exempted anyone who's cleared level 1 and level 2 of the CMT program from their Series 86 exam, which was their licensing exam for research analysts. So that was a big win, and from that point on, CMT became a professional regulatory organization in the US. Since then, the Nebraska Department of Banking and Finance, IROC in Canada, and a number of other regulators have also provided license exemptions and have again accepted the credibility of the CMT charter. I'm in fact engaged with SEBI. We are talking to Monetary Authority of Singapore, a number of other organizations as well. In India, the first office, and this is the first office of the CMT Association outside New York, eventually got set up in India in 2018. And I am therefore the first employee of the CMT Association outside New York. So I like to call myself the first wave of the global expansion. Right? So that is kind of the history of the CMT Association and where as an organization we come. I'll talk to you a bit more about how we are working with educational institutions. But technical analysis, Abhishek has done a brilliant job of explaining. Just one layer that I want to add is this graphic I want you to keep in mind. Yesterday, Professor Banerjee spoke at length about trying to identify the intrinsic value of a stock, the price that the stock should be at. If the price is not where it should be, then there's an investment opportunity. So understanding intrinsic value is inevitably very important when you're trying to understand a company. Technical analysis helps you to navigate the gap between intrinsic value and the actual market price. Because while intrinsic value comes from accounting estimates, valuation estimates, and so on and so forth, the actual market price has a layer on top of human emotion and sentiment, market sentiment, supply and demand also acting on it. So understanding these two together is always incredibly important. That's something as an association we believe in very strongly. But where does TA fit in the industry? It fits in not only if you are in any kind of role that observes the markets. So if you're directly observing, interacting, and trying to understand the markets, whether it is trying to focus on, let's say, the role of a trader, the role of an analyst, the role of a portfolio manager, the roles of a treasury manager in, say, a bank or a corporation. All these roles look at the market and engage with it directly, right? So that is one kind of role. But also if you're facing customers and have to talk about the markets meaningfully, then also technical analysis becomes very, very important for you. Because say if you were a client advisor for, let's say, IIFL Securities, and your job was to advise your clients on investment opportunities and help them protect their capital once they have invested, the aspects of risk management that Abhishek spoke about become incredibly important here. So while engaging with customers in a markets-related role, also technical analysis becomes incredibly important. So you realize automatically the kind of roles that you can do where technical analysis helps you is tremendous. So what is technical analysis? What is the depth and breadth of it? It's probably worthwhile to check out the CMT website to see the curriculum, but this is broadly the body of knowledge. 3 levels. One level is the first level is kind of introductory in nature. It kind of introduces you to broadly what are the concepts in technical analysis. I mean, it's a large body of study, like Abhishek also mentioned, obviously not possible to cover in a 3-day workshop. So like Professor Banerjee suggested, deeper study is required for those of you who are interested. Right? So level 1 is an introductory level. Level 2 is more of application of the concepts that you learned from level 1 and gets a little deeper. And level 3 is the integration to actually apply it in various professional contexts, in the space of risk management, asset management, portfolio management, and the understanding of behavioral finance. All of these become very, very important. And that is why the industry respects the CMT qualification as much as it does. Right? So that is why we're seeing more and more, senior professionals as well. We even have, in fact, market professionals with 25 plus years of experience going through the CMT program so that they can enhance their career opportunities. The CMT program itself is, we have candidates from across 134 countries. Exams happen every 6 months in June and in December. And the process is you enroll for the exam, take the 3 levels, and eventually are able to clear each level and move forward and then be ready to apply for your CMT chart, right? So I'll come, like I said, I'll answer questions about this also as we go. Now, the academic partner program, I must mention to you. So IEM signed an MOU with the CMT Association to create opportunities for students as part of the academic partner program. So as part of that, what students get access to is one, IEM has committed, and this workshop is one manifestation of that, um, towards helping the teaching and learning of technical analysis and furthering that among the student ecosystem. And so, in order to support that with the CMT program exams, this little table that you can see over here, uh, we offer very deep scholarships to full-time students of IEM in this case, right? And all our other academic partners. So we have academic partners as well around the world. And so full-time students of academic partners are eligible for scholarship to take the exam as well. I think this is something that was discussed with you already, so I'll not spend too much time there. But in addition, I want to mention we do conduct internship challenges and investment challenges as well. And in fact, one of your students, Ritik Poddar, has won a couple of prizes in the investment challenge that we conducted recently. And as a result, we in fact were also able to, so after the investment challenge, we shared the results with a number of broking houses. And one of them actually has 4 job opportunities for which they want to interview the winners of the investment challenge. So Ritik will be in fact interviewed by one of them as well. Among others, there are other winners as well who've shown interest in these job opportunities, right? So the investment challenge as well will continue to grow in profile, but that's another opportunity for students to participate and kind of be part of the CMT environment, the ecosystem. Now, in introduction to technical analysis, I will not talk to you about technical analysis the way Abhishek or Prasenjit covered or will cover. I'll talk to you from a more philosophical standpoint. So Charles now said something very interesting when he started writing about technical analysis. The understanding of trends is like the understanding of tides. You see the tide moving forward, but it does not move in one straight line. There is ebbs and flows to a point beyond which at one point it does not flow further, but then it continues and the trend reverses. So that is something that's a very interesting observation that I always felt. So touching on that, Abhishek touched upon some of this as well. What are the primary assumptions around technical analysis? One, it is driven by supply and demand. Some people believe there is a buying opportunity, others believe there is a selling opportunity. And depending on which of those is more, the prices of securities tend to move, right? Changes in supply and demand cause reversals in trends. So if there was greater supply than demand, the price is likely to go down. And if there's greater demand than supply, the price is likely to go up. And patterns tend to repeat. And that's a very interesting kind of basis in behavioral psychology, which we just touch upon very briefly. Right? I just spoke about this a little while ago, but it's important once again to understand that there is tremendous value in looking at both fundamental and technical analysis while making an investment decision, navigating the gaps. So while you understand what the intrinsic value of a security should be, taking a look at its price and trying to understand that also is equally important. So that is where the statistical analysis of this gap is really what technical analysis is. What it is not is fortune telling. So there is this perception among people who do not understand technical analysis that it is about guesswork and it is about self-fulfilling prophecies, and that is an unfortunate perception that people have, right? But one part that you will see, like I mentioned, the patterns that repeat in charts, or the patterns that repeat in life, all are cyclical. And this is a very fascinating, and I really love this graphic because it tells the story quite nicely about what happens when you enter a trade. Now, for those of you who have any trading experience, you will know exactly how all of these emotions work. For those of you who do not, I would invite you, IEM students especially, this is relevant to, do participate in the next investment challenge so that you actually are able to experience these emotions, to see what happens when you enter a trade, the optimism as it goes in your favor, the insane sense of self-confidence, thinking you are Superman when the trade is giving you a lot of profit, but at the same time, the kind of panic that happens when trades go against you. Like, we could have talked about this in length, but in the interest of time, I'll move on for now. And this reflects in business cycles as well. So this is a very interesting way of representing it, that the market prices, it's the gray line, typically is followed by the earnings per share line, which is an understanding of the business psychology, at any point in time. And typically when there's a change in direction is where technical analysis becomes really relevant. Because technical analysis is a much faster way to interpret what the emotion in the market than fundamental analysis. And that is where it becomes incredibly useful as a tool to overlay on your fundamental analysis process. But why does this happen? And why do prices and why do patterns and why do behaviors tend to repeat themselves? So in the past 15 years, a lot of research has been done on what is now called behavioral psychology. And behavioral economics as a result of that. Previously, when so at least when I was a student and when your professors were students, we all learned about the economic model. So the concept of an economic man, a human being who makes rational decisions based on data available. And often we found that it became sometimes difficult to explain real world phenomena using the model of an economic, perfectly logical man. So how do you then make sense of it? And over time, behavioral psychologists through a lot of research came across a few inherent biases in human beings, right? And I'll just quickly run you through these biases because these things happen not only in trading or in the financial markets, but in life as well all the time. So it's very valuable for you to just keep an eye open for it. But like I said, in the interest of time, I'll not spend too much time on this. Maybe some other time we can talk about this in depth. But overconfidence bias, right? That happens when just because it's kind of a false sense that your skill or talent is the result for everything to happen. And that's something that's a very dangerous bias as well because you tend to give too much credit to yourself when things go right and not enough blame when things go wrong, right? You should, if you get an opportunity, read about the Dunning-Kruger effect as well. It's a very interesting graph. Actually, I should maybe put up an image of that graph also alongside here, which talks about how your opinion of yourself in any skill area does not grow in a linear fashion with your skill in that area, no matter what it is, right? When you start learning a new skill, first in the beginning, your opinion goes very high, very fast. And then suddenly you reach what in the Dunning-Kruger effect they call the peak of Mount Stupid, where for very little skill, you have an inordinately high opinion of yourself. And then you see a crash. Because as you learn more, you realize the gaps in your knowledge previously, and then again, kind of your opinion of yourself crashes, and then from there, as your skill continues to grow, it builds up and comes to what eventually is sustainable. Like I said, the next time we talk, maybe I'll put that graph as well over here. It's quite interesting. The self-serving bias is kind of related to the overconfidence bias. It's basically a self-serving narrative to think that whenever something happens well, it is because of your skill. But if something goes wrong, it is because of bad luck. If you enter a trade and goes in your favor, it is because you are a genius analyst. But if you enter a trade and goes against you, it's because, oh, the market just misbehaved. So that is a self-serving bias. We tend to explain things in this way very often. Herd mentality is something you will have heard a lot of. It's just about blindly doing what others are doing. And this happens in careers. This happens, and over the past 20 years that I've been working, I've seen this among students. I myself, in fact, when I was an engineering student, chose to get into MBA just because everybody else was, and I could not be bothered. When I started preparing, and eventually towards the end of my engineering, I started to think whether that was the career I wanted, and eventually I made an educated choice that moved away from the herd. And that has made all the difference, like the poem says. But herd mentality, and I would always caution you against that. Doing something simply because other people are doing it. Very, very dangerous, right? Always applying your mind to a situation is important. So with these biases, right, it's important to constantly pay attention to, am I a victim to any of these? And this is about life. Remember, it's not just about the markets. Markets are just a very clear, quick translation of what happens in real life. Loss aversion. This is another interesting thing. So if I give you a coin toss offer, saying that if you win, If you say, if you head or tails, if you win, I give you 3,000 rupees. But if you lose, I'll take 2,000 rupees from you. Research suggests that most people will not take that bet because although there's a likelihood of winning higher than the likelihood of losing, the fear of losing causes people to not take a bet, and that's a very common tendency. That's why people tend to see the danger of loss much bigger than the likelihood of a gain. The framing cognitive bias. This happens often because of, okay, why do you think in ads you always have very successful, attractive people selling you things? Because the way something is presented to you makes a very big difference in your decision about that. Advertising campaign is built entirely on this framing cognitive bias. The narrative fallacy, again, a story. If you notice a lot of crowdfunding sites, for instance, of late, when they ask for funds for any project, always give a human story about it. So I was the CEO of an edtech startup that worked in the social sector, and we set up India's first crowdfunding platform for teachers. So we used to we created a platform, and we first put out just basic statistics of if these tools are provided to these teachers, they'll get this benefit. Nobody cared about it. But then we started writing stories about here is a professor or here's a teacher in this primary school in this village in Khati in Uttarakhand. And here is the story and here's what he did. And the moment we started writing stories that way, automatically people were more willing to contribute. But that, remember, feeds off a bias of the narrative fallacy. Anchoring bias, another simple question. The question is car number 2 expensive? Okay. Car number 1 is 20 lakh rupees, car number 2 is 12 lakh rupees. Is car number 2 expensive? Some people will say no. I'll ask the same question to a different group. Car number 1 is 5 lakh rupees, car number 2 is 10 lakh rupees. Is car number 2 expensive? Most likely people will say yes. Because we have a tendency to anchor, which is why also when you try to purchase any products online, you always see that companies give 3 options of a product, and the top price of the top option is usually ridiculously priced, because they want people to anchor themselves to the top price and then settle for the next price, which might not be a significantly worse product, but still people anchor and think that they are paying lesser than the top price rather than thinking that they are paying in absolute terms a higher amount of money. That is anchoring bias. Confirmation bias this is another dangerous thing. Just because you enter a trade, you will look for information that supports your theory. If you support a football team, right, you will tend to ignore data that tells you that this football team was not likely to win the championship, and only look for data that tells you that this football team is likely to win the championship. It works in football, it works in politics, it works in life, it works everywhere. But it's a very dangerous bias. If you buy a stock and then start looking for reasons why the price should go up, even when the price is going against you, that bias is working against you. Right? Hindsight bias. A lot of people, this is one thing to understand with technical analysis or fundamental analysis as well. It is a science of estimation. You are trying to understand the future. So looking at a point in time, you should backtest your information. But always remember that hindsight, you will feel that, oh, I would have seen that possible pattern in the price or that possible change in my estimates early on. And that bias needs to be guarded against. After the fact, everybody thinks that they knew it all along. Right? Representative heuristic is this tendency to think that just because two things are similar, they might be related also. This is another very common bias that comes up. But anyways, moving on from there, and I want to talk about careers for a while. But I want to touch upon one kind of area of concern that I've always felt is this debate. People keep saying, what is better, fundamental analysis or technical analysis? That is the wrong conversation. Right? It is not about what is better. It is about how can you make the best investment decisions with the tools and the information that you have at hand. The PE ratio, something that Professor Banerjee spoke about at length yesterday. The PE ratio itself contains a fusion of fundamental analysis and technical analysis. The fundamental analysis starts from the bottom, starts with the estimates. And because in order to analyze the estimates and in order to estimate future revenues and future growth of an organization. You have to see past growth, past performance of that organization. You have to analyze statements. There's a lot of in-depth work per stock required within that one small ecosystem. So fundamental analysts typically are able to cover a small universe of stocks. Technical analysts, on the other hand, start from the top. They start from price. And so they are able to cover a much larger universe of stocks because the number of data points that they are working off of is far fewer. Right? So it is important also for fundamental analysts, therefore, to take a look at technical analysis to help them to look at the ecosystem. While you can cover maybe 20 or 30 stocks with a certain amount of effort, you can't cover the entire industry. But keeping an eye on the entire industry is incredibly important. So for fundamental analysts, learning technicals is that much important, that much more important. Another way to look at it is price on one side, earnings on the other. Price is a fact, earnings is an estimate. Price can never be restated, earnings can be revised. Price is based on technicals and earnings is, price is the basis of technical analysis and earnings is the basis of fundamental analysis. But we always recommend look at a fusion of the two. For instance, if you are analyzing a company, in this case IBM, Apple, or whichever company in the world, Tata Motors, that you want to analyze, fundamental analysis goes from the top and looks at the company, the demand growth, competition, margins, all the fundamental factors that affect the company. Technical analysis looks at the price, the volume, the sentiment, the relative strength. These two are not competing with each other. They are complementary to each other. If you look at only one, you look at only half the picture. That's always important to understand. And that is why the synergy of the two is important. The fundamental analysis of any security, and this is not just about stocks, mind you, it's any kind of security, right? Whether it is stocks, that is shares, derivatives, futures, options, whether it is bonds, whether it is currencies, whether it is commodities like metals, food grains, all of that. Understanding the what and the why is the fundamental analysis. Understanding the when and the how on the basis of price action is technical analysis. You analyze the underlying entity in fundamental analysis. You analyze the security price in technical analysis. Cause and effect, right? So somewhere in the middle is that beautiful sweet spot that you should aim towards. The only difference I would say is the access to data, right? Fundamental analysis requires a lot of depth, a lot of research, a lot of getting into the weeds with a single security to really estimate meaningfully what the price of that security could be. Technical analysis looks at it, it's a more accessible skill set, right? So that is why I recommend that irrespective of what else you do, learning technical analysis on top as a skill is incredibly valuable for you. So a few applications of technical analysis: defining trends, understanding supply and demand, momentum, and relative strength. So this is something that we will dig deeper through the course of the day as well, right? But the tough questions: do either of these predict the market consistently? Difficult to say, right? The fact is that none of these can predict the future. Nobody knew that COVID was going to happen and affect the world. And even when it affected the world and the markets were crashing and going crazy, nobody knew that all of a sudden it would stop and turn and zoom up to all-time highs again. But it happened. So the question is not about whether you can predict the markets. The answer to that is what George Soros says. It is not whether you are right or wrong that is important, but how much money you make when you are right versus how much you lose when you are wrong. That is the incredibly important thing that anyone as an investor needs to understand. So the risk management, the philosophy behind risk management is this: accept that mistakes will happen. Even a good technical analyst will never be right 100% of the time, right? But knowing that if you are able to manage your risk, when you make small bets, you cut your losses early, you let your profits run, and then you will become profitable in the long run. Right? So that is kind of what I wanted to say about technical analysis. Now let me quickly touch upon the careers that are open to you by looking at the world from this lens. Obviously, you will have realized that one thing that you can do in parallel with no matter what career you choose is invest in the markets and manage your own money on the basis of technical analysis that you learn as a skill. Right? But apart from that, I like to tell the story of careers through the story of risk. And I'll give you the shorter version of it. Right? The shorter version of this story starts with a ship that is sailing on the sea going from Australia to India carrying coal, right? Now, this is carrying coal because Adani Power, suppose in India, has contracted this ship to bring this coal from Australia, which produces some of the world's best coal, to for their plants. It'll come to their port in Mundra, and from there, it'll be taking their plants. They'll produce power because Adani Power is in the business of producing power and selling it to the people, right? But suppose there is a storm in the sea, and as a result, the ship is likely to get delayed for a month. What does Adani Power worry about, right? One is, of course, the material losses of what if the ship sinks. But today there is technology to warn people if a storm is forming well in advance, and so they can wait outside the range of the storm. And like for instance, the cyclone Tau thing, right? People who are operating large ships were able to see from a distance that a cyclone is forming, and then did not go into that region. But there were delays. So those delays are something that the Treasury Department of Adani Enterprises worries about. And they are worried about the commodity prices because they bought coal, the price of coal fluctuates all the time. And they bought coal in Australian dollars, and they are eventually transacting in the Indian rupee. So they are concerned about what is the movement there as well. So what they do is they analyze the markets. They try to understand that on the basis of the trends of both coal prices and FX prices, FX currency rates, what should we do to protect ourselves from this 1 month risk? Because remember, Adani is not in the business of taking financial risk. The risk that Adani has taken is the risk of setting up a power plant and supplying power. That's a business risk, right? So financial risk they want to mitigate. So to do that, they reach out to a panel of banks. And they have done their internal calculations based on their estimate of the trend, and they say that, okay, fine, we want to go with some kind of a hedging instrument. That instrument could be a future, a forward, an option, a swap. So remember, what I'm trying to show you is how is the risk moving from Adani? How is Adani trying to give away the risk, the financial risk that they are facing? So they reach out to all their banks and say, okay, here is a swap, let's say an option that we want. Give us a price for this option. So all these banks will also receive this request for quote. That's called a request for quote from Adani, and they will do their calculations and they'll say, okay, fine. On the basis of these parameters, we can charge this option premium over and above the risk parameters that they have applied. So that is how the bank makes its money. So the risk has flowed, and so Adani will get its quotes from its various banks. They will say, okay, fine, good, one of this, the best quote they will pick, and they will transact with that bank. So the risk has gone from Adani Enterprises to the bank. Remember, this is happening across all kinds of enterprises, companies, whether it's Adani, Tata, Reliance, and from there onwards towards small companies as well. They're all trying to mitigate their money risk. Now, all these banks, it is not their job, although they're collecting all this risk from various players, it is not their job to keep the risk. So they transfer the risk using market intermediaries. Now, these intermediaries are brokers of various kinds. They transfer this risk over to asset management companies. Because asset management companies are in the business of taking risk in order to generate a return. Remember, when you are investing capital in any kind of security, whether it's a stock or it's a bond or anything else, you are taking a risk. And you are taking a risk with the intention of getting a return. And that is what asset management companies do. So they interact with the brokers, and so from the banks, between the banks and brokers, they conduct a process of what is called securitization. And then that risk is transferred from the bank through the broker to the asset management company. So that is one journey of risk. But Adani, I told you, was in the business of taking another risk, the risk of generating power and selling it to people. And for that, they need money. And money they can raise in two ways, a number of ways, but mainly two. Either issuing debt, that is writing bonds, CDs, CPs, or issuing stock. So for both of these, again, they engage with a broker of sorts, typically what you know as an investment bank, right? And they work with the investment bank, and both of them analyze the markets once again, see what the trends are, see what the performance of various sectors are, the relative strength in each sector, so that they can determine what should be the price of their stock. Then the investment bank takes that and either reaches out directly to asset management companies in what is called private placement, or the stock is offered on exchanges. And on exchanges, then people like you and me can transact through retail brokers as well. So whether it's large fund houses and asset management companies, your mutual funds, pension funds, insurance funds, they can transact, but they have to go through brokers to the exchange. Or Common people like you and me can also transact, going through brokers to the exchange. Fires, for instance, is what you know as a discount broker. But you have full service brokers like IIFL, JM Financial, all of those as well. Different kinds of services. Now, just let's take a quick stop at these two asset management companies. Where did they get their money from? They also collected this money from retail investors who want to make money. So either the investor can directly invest in stocks, shares, bonds, etc., or they can park their money with asset management companies through distributors. So asset management companies also can't go out and find people. So there are distribution agencies as well who try to reach out to the investing public, whether it is, let's say, the common public in broad sense, or high net worth, ultra high net worth people. It's just about how much money people have in order to risk so that they can make returns out of that. So what I've tried to explain to you in these 6 minutes is look at this entire industry. Between any two industry types, right? Any two sub-industry types, whether it's broking, investment bank, asset management, banks, corporations, you can draw a line between the two. And that line of interaction has two aspects: analyzing the markets and engaging with customers. Okay? So, and across both of these, like I mentioned earlier, technical analysis plays an important role. So, which is why understanding technical analysis becomes extremely valuable for you as any kind of future market professional working in any of these industries, or even if you are not in this industry, but you are a member of the media paying attention to the space, or you are a professor, a teacher trying to teach about the financial markets. Understanding these interactions and by extension, understanding technical analysis becomes incredibly important. Now, within each of these kinds of organizations, there are three kind of sub parts of the business. Okay? One is the front office, one is the mid office, and one is the back office. When I told you about these transactions and interactions and the analysis of the market, the decision-making side, that is typically called the front office of an organization. And within an organization, mostly that is where technical analysis is important. I'll talk to you about roles specifically also. In the mid office and the back office typically are more not just market but operational risk management as well. And back office is more about ensuring that the data of the company is consistent, clear, and maintained well. Right? But the front office roles across, so focusing on the front office roles across industries. Here are some of those. You see the first column talks about the typical role categories: analyst, trader, dealer, sales and relationship management, portfolio, strategy, leadership. So it is not just a person who's directly engaging with the market, but even leadership and strategy people across all these industries have to understand technical analysis to some degree or the other. So as people become more and more senior, they start paying more and more attention to this, right? These are just some of the roles that are available for people in what I call traditional careers or the traditional financial services industry. These are all the kinds of roles where technical analysis becomes extremely relevant, right? Apart from that, there are more modern careers as well. Now, with the increase in computing power, quantitative finance, algorithmic trading, systems design, the application of machine learning, artificial intelligence. Cryptocurrency, I put 3 stars against that because it is just a different asset class. But nowadays, people are so excited about it, and everybody says, in the modern careers, is crypto counted? Crypto is counted, but from the technical analysis perspective, trading of cryptocurrencies is like trading of any other asset class. The same risk, the same analysis, the same thought process applies, right? Non-finance careers in the world of journalism, in the space of education, teaching is obviously a tremendous responsibility, and research as well. So for the faculty members, there's a lot of very interesting research work going on right now in these areas from the lens of technical analysis. So at the CMT Association, we also have something called the Journal of Technical Analysis, which is an academic journal, double-blind, peer-reviewed, which is used for publication. I mean, research faculty publish in this as well. And like I said, these are some of the areas in which a lot of research is happening. Want to learn more? Again, the CMT body of knowledge is the gold standard for it. And your institute has actually already taken the initiative to help you go through the program by signing the academic partner program MOU with us. Okay? So level 1, 2, and 3, just a quick breakup of the exams for those of you who have, I've just made these slides in response to the difficult questions that I get. Right? Level 1 is, I wouldn't call it easy, but it's kind of foundational level. So that people from all kinds of backgrounds, whether it's engineering, like a number of you, or whether it's poetry, arts, a lot of people want to transition into the financial markets and see the CMT program as a way to do that. So that's something so that's where level 1 comes in. Level 2 becomes the application. That's a relatively tougher exam. And then level 3 is about the integration of all these concepts so that you can actually build your own systems. And that is where the industry recognition really starts coming. Right? The academic partner program, once again, just a quick reminder that if as students you take the exams, for full-time students, undergraduate students, full-time of academic partner programs, which means the institute has signed the MOU with us, there is a scholarship for level 1. For graduate students, that is, you finished your undergrad program and you're doing a postgrad program, level 1 and level 2, for both your scholarships apply. For full-time faculty members, you will be happy to know that scholarships apply for level 1, 2, and 3. But full-time faculty, not adjunctive. So that's just a quick overview. But why do people do the CMT charter? Why do they get it? This was some analysis that we did across CMT charter holders around the world. And most of them reported that they either got a promotion or a new position, more responsibility, or even got contacted by a recruiter just because they had the CMT against their name. Right? So that's something that, and then of course, increasing salary, bonus. So this is something that we've been seeing a very positive kind of growth of the value of the CMT charter. And that is why around the world now we are having these more and more advanced domains of knowledge we've spoken about briefly. This is for all of you students. And how can you be engaged with us? So the investment challenge, like I said, we conducted. It was quite a big success. We're hoping to conduct 2 investment challenges every year. And obviously, this is open only to CMT program candidates and full-time students of academic partner program schools. Right? The other space that you can engage with us is on Discord. So Discord is this communication platform. It's kind of similar to WhatsApp in that it has all these app kind of things. It has a mobile app for Android and Apple and all that. And also it has a desktop interface as well. And we've created a channel for the CMT Association where you can come and interact with us, engage with us. Right? So this is a space where you can not just engage with us, but also other technical analysis enthusiasts around the world. Right now, there are more than 1,000 people on this already. There are already conversations going on about market events, about technical analysis, about what's going on in the world, about how you can learn better, grow more. Or for candidates and members, there are some exclusive areas as well where you can get access to more exclusive communities. But in general, this community is open. So if you want to access the community, go .cmtassociation.org/Discord. Okay, that's the space for you. But that's all I have to say. I tried to bring it home and went just about 5 minutes off budget. But if you have any questions, now is the time to ask it. One very important question that I think you would be asking yourselves right now is, what is there for lunch? So obviously, and this kind of brings us to the end of the morning session of the workshop. And if you have any questions, once again, feel free to raise the Professor Swagata. And now in the next session at 2 p.m. when we get together, Prasenjit Biswas will take you through the practical applications of the concepts that Abhishek has taken you through. So how do you look at the universe of stocks? How do you use basic freely available tools like Excel or TradingView or all these other charting softwares, etc.? How do you actually use them to actually apply the concepts that Abhishek talked to you about in a hands-on way, right? So I hope you enjoy that session as well. I'll try to join and be there, but even if I can't, my best wishes are with you. Professor Swagata, any closing comments before we break for lunch?
Yes, one Shomik Chatterjee said, what is the time to period of
time
CMT
period
program?
Of the CMT program,
Yes.
and is it online or offline? So the CMT program is designed to be a self-study program. Each of the 3 levels you can prepare for, and the exams happen every June and December. So now the next exams are happening in June from the 3rd to the 13th. And after the June exams end, registrations will open for the December exams. So in that sense, if you are able to clear each level in one go, it should take you about 18 months to be able to clear all 3 levels. And so in addition, if you are paying attention to the table, like I said, the Wiley curriculum is something you can have access to. Wiley reduces the prices for academic partner schools. And Optima, this company based in Australia, offers its charting platform for free to all candidates registered for CMT exams. And it offers a video course for level 1 for free as well. Right? And that is something that can be done online. And there are a few other companies, etc., that provides kind of coaching and training, etc., for the CMT program. But by and large, it was designed to be a self-study program. Testing is done through our testing partners, Prometric, who have test centers all around the world. But Prometric also offers the facility for you to be able to take the test at your own homes as well. So the test can be taken. Of course, you have to meet a few security criteria, system criteria, but you can take the test from home, or you can take the test from a test center. That's also possible. Right? Great. Thank you so much for your question.
Okay. So now we just end the first session. We will meet on the 2 p.m. Okay. All the students, please join the before the 2 p.m.
Right.
Okay.
So I'll take one question,
Yes,
one
yes,
more question
yes,
from Shobham
yes.
Majumdar.
Yes,
This
yes.
has to do with careers. It's a nice question. If
Please.
one is interested to become a machine learning professional concentrated in the trading sector, what is the learning path? How can the CMT certification help? And what is the typical learning path of algo trading? So for both algo trading and in general, if you want to be in the trading space and you want to apply technologies like algorithms or machine learning, see, machine learning, you need to understand, is not a separate end in and of itself. Machine learning is a protocol that is applied to the development of systems, no matter in what. As long as you have large sets of data, you can program your applications to learn consistently from this data and refine the process of execution from that on that data set, right? So machine learning is something that can be applied across anything. So if you to the point of your question, if you want to focus in the trading space, algorithmic trading or trading in general, and inevitably when you are building a trading system, it will be an algorithm. So what your question is broadly kind of, you want to be an algorithmic trader, and will the CMT certification help? The CMT certification, so there are two sides to this. One is the technology side, or the coding language, the coding tools that you use. And two is the rules, or the, so think of it like language, right? You might know a lot of words, but if you do not have thoughts to express those words with, then there is no use of knowing the words. So it is important to know the various technologies or tools. For instance, nowadays, the more popular languages are R, Python, and you have JSON, etc. So learning those and learning whatever is the latest language at the latest coding language at the point in time is important. But at the same time, learning the first principles of decision making. That is where the CMT curriculum focuses. So we also, as an organization, had come to this crossroads about whether we should add more technology and languages and programming, etc., in the curriculum. But we decided to take a step back from that and focus only on first principles. So because technology will keep evolving, languages will keep evolving. When I was your age, the language of choice was C, C++. You guys are still learning, I think, C as part of your curriculum. Let me boast over here. So most of you, I would imagine, are learning C from this book called Let Us See by Yashwant Kanetkar. I was taught C by Yashwant Kanetkar. He was a professor in our college, and he also used to separately run an academy of his own. So that's when I went and learned C from. But that was back then. The world has evolved so much since then. You came from C to C++ to V, C++, Visual Basic, and it just continues. And in the past 20 years, so much has evolved, and it will continue to. So as a technology professional, you have to continue to remain on the cutting edge. Know what is going on, know what the latest languages are, and keep learning those. But at the same time, you cannot lose sight of the first principles. What will you say if you have no thoughts to express? Similarly, what will you write code of if you don't know what an algorithm is, or what are the rules behind the algorithm? That is where technical analysis comes in. So quantitative finance tries to do a combination of technical analysis rules, so that forms a very important part, which is why you have a number of CMT charter holders who in fact run their own algo trading firms as well. They hire coders to write the code for them, but they come up with the ideas and the trading systems, right? So that's one way of going about it. So if you want to stay in the financial markets and specifically in the space of trading, then the CMT qualification can be incredibly valuable. If you just want to be kind of a gun for hire across sectors, then just learn the technology side could be important, but you'll have to pick up domain knowledge across any sector that you're going to. So ML, AI, all these things appear everywhere. Wherever there is data, you can write algorithms to learn better and better from that data, and that is what feeds what we now understand to be artificial intelligence. Yeah. A very long answer to a very short question, but I hope it was useful to you. Right?
Thank you, Joel.
With that, it's time for lunch. Thank you, Professor Shagado.
Okay.
And we catch up at 2 p.m.
Okay.
Bye-bye.
Thank you. Thank you.